Good morning, everyone. Our last session on consolidation today. Good morning, Soham. Good morning. So today we will be commencing with a question that I had told you to solve in the previous class, if I am not mistaken. The question relating to dividends. Okay. There was one question I had requested you to do it for homework, but that was only for your practice sake. I told you I'll be doing it today. So we'll start with the question. Good morning, Namaste. Good morning, Srishti. Good morning, Sumit. Okay, so let us start the session with a question. Okay, so come to question number 8. Come to question number 8. Okay, all right. So we start up with this question. I hope you have tried. I'm not sure if you have. If you have, you can just compare your answers. Okay. All right. Ram Limited acquired 60% ordinary shares of rupees 100 each of Krishan Limited on 1st October 20X1. So this is during the year. On 31st March 20X2, the summarized balance sheets of the two companies were as given below. So you are given land and building, plant and machinery, investment in Krishan Limited, inventory, trade receivables, cash. On the equity and liability side, you have share capital, reserves, retained earnings, bank overdraft, trade payables. The retained earnings of Krishan Limited showed a credit balance of 60,000 on 1st April, out of which a dividend of 10% was paid on 1st November. Ram Limited has credited the dividend received to its retained earnings. Fair value of plant and machinery on 1st October was 4 lakhs, rate of depreciation being 10%. Following are the increases on comparison of fair value as per respective Ind AS with the book value as on 1st October 20X1, which is to be considered while consolidating the balance sheets. Trade payables 20,000 increase, assets, land and buildings increase by 2 lakhs, inventories 30,000. It is assumed that the inventory is still unsold on the balance sheet date and the trade payables are also not yet settled. Also assume that the other reserves as on 31st March 20X2 are the same as they were on 1st April X1. Prepare the consolidated balance sheet as at 31st March 20X2. Okay, so with this we start. I think I have my format in place. Yes. So this is the format. So the first step is always drawing the consolidated balance sheet from the question only. No breaking your head. Okay. Once this is done, we move on to note number 1, assets and liabilities. Copy as it is. Okay. Copy as it is. That will ensure that our processes remain the same. So copy the data, land, building. So we take into consideration 1, 2, investment won't be copied, inventory, trade receivables, cash, equity and reserves won't be copied, bank overdraft as well as trade payables. So these items we will copy, okay, without any adjustments. Don't look at any adjustments right now. 3 lakhs, 360. Then 480, 270. So total of this comes to 7 lakh 80, 6 lakh 30. Okay. Next, I'm having inventories 240 and 72, 800. Then 1 lakh 19, 600 and 80,000. Next, 29,000, 16,000 cash. One lakh 60 overdraft. And trade payables 94,200, 34,800. So you are done with note number 1, that is copying the values of assets and liabilities. Equity capital of the parent only will be considered. So parent is Ram, so 10 lakhs. Okay. All right. So 10 lakhs, 100 shares, that means 10,000 equity shares. Ten lakhs. So we can copy this into the main answer. There won't be any change as far as this is concerned. Note number 2, 10 lakhs. Okay. All right. Fine. Let us then move on to consolidated other equity. We are having how many items of reserves? 2 items. Other reserves and retained earnings. So we'll just write that and keep. First we'll write retained earnings. This will come from working note 1. Working note 1. Okay. So we are yet to calculate this. So we'll come to working note 1. Consolidated other equity. So we will now take the value from Ram Limited, that is 6 lakhs and 1,14,400. So standalone Ram Limited. Other reserves is 6 lakhs and retained earnings is 1,14,400. Okay. Now we are left with only one thing, that is the investment. We will eliminate it through the cost of control. Okay, this has no investment, so it's also done. So investment eliminate through the cost of control. Eight lakhs. Okay. All right. So see, within the first 5 minutes, because the formats are ready, all these things are done. See, ideally you get a consolidation question, a full-fledged question for something between 12 to 16 marks. Okay. So when you get a question on consolidation between 12 to 16 marks, there are a couple of things you have to remember. First one is you cannot overspend your time that is there. Okay. Generally, students have a tendency that जब question आता है, since it is a familiar question, you tend to go overboard with the presentation. आप बहुत ज़्यादा खूबसूरत बनाओगे, you will do all kinds of makeup to your solutions, and then what happens is you get the answer correct. There is no doubt in that. But when you look at the time you have invested, probably 1 hour would have passed. Okay. And then you will have to complete the remaining 85 marks in say 2 hours, which is an overshot practically. Okay. So ensure that you have adequate practice as far as the speed is concerned. Okay. You will have to ensure that a 16-mark question should not take you more than 25 minutes. Okay. And when I talked about 25 minutes, I mean the complete tallied balance sheet should be over within a span of 25 minutes. That is drawing the formats, getting the working notes done, balancing the accounts, tallying the balance sheet, all your workings. They should be done within a time span of 25 minutes. Okay. So once you gain familiarity with the topic, please try to practice and ensure that you complete the question within a time span of 25 minutes. Otherwise, it's pointless to spend a lot of time. Okay. All right. So ये हो गया investment in Krishan Limited. Now we start splitting up the equity share capital of the NCI. Okay, of the subsidiary. Okay, so we have acquired what stake? We have acquired 60% stake. So NCI stake is 40%. Okay, so we can write here 60% stake. So NCI will be 40% stake. Fair value of NCI is not given, so we will be following proportionate share of net assets. Okay, so now we proceed to cancel the equity capital. 4 lakhs, let us divide it. So by equity share capital of Krishan Limited, 4 lakhs into 60%, that gives you 2 lakh 40. Go to NCI of Krishan Limited, 4 lakhs into 40%, 1,60,000. Fair enough. So that has eliminated, and now we are left with two things, that is reserves as well as retained earnings. So other reserves, we will keep it as it is. We will not make any adjustments to other reserves. Whatever fair value adjustments or dividend adjustments, whatever is there, we will take it from retained earnings. We will take it from retained earnings. So other reserves is 2 lakhs. Okay. So this is balance sheet of Krishan Limited. Okay. So now if you look at it, it is 2 lakhs, and they have told that assume the other reserves as on 31st March are the same as they were on 1st April 20x1. That means koi change nahi hai. So let us do the split. Pre in this case is up to 1st October 20x1, and post in this case is 1st October 20x1 to 31st March 20x2. For here it won't make any sense because it's entirely outstanding from the opening. So entire balance is pre. So this we will be splitting it between the parent Ram Limited and NCI. 60%, 40%. So that leaves you with how much? 1,20,000 and 80,000. Where will this NCI portion go? Working note 3. Where will this go? Working note 2. Okay. So go to your cost of control account by pre other reserves. Working note 4. So this comes to 1,20,000. And then here you will be having NCI pre-acquisition other reserves, working note 4, 80,000. Okay, so that takes care of this reserve also. And you are then left with only one reserve, that is 1,64,000. Retained earnings 1,64,000 balance sheet of Christian Limited. Okay. You have a couple of adjustments to do. Okay. Now, retained earnings is 1,64,000 as on which date? Sir, this is as on the consolidation date, which happens to be 31st March 20X2. That's right. Sir, are you given the opening balance? Yes, it showed a credit balance of 60,000. But be careful of the dates. This is the balance on 1st April 20X1. This is pre-acquisition, no doubt. But you have acquired on 1st October 20X1. दोनों के बीच में 6 महीने का gap है. There is a gap of 6 months. That means the profits generated by the subsidiary for the period April to October, the profits for this period also would be post-acquisition. What will happen is if you take 1,64,000 and pull 60,000 as pre and take 1,04,000 into post, you will be wrong for the simple reason that you are considering the first half year of 20X1, X2 as a post-acquisition period profit, when in fact it is a pre-acquisition period profit. So you cannot do a direct split like how we used to do for the other cases. Okay, so this is an acquisition that has happened during the year, so we will have to do the work as per whatever data is there. So we have to assume that it is evenly accruing throughout the period. Okay, so now let us proceed with this. Okay, so since it is happening in the middle of the year, we will have to look at how will we do the split. Okay, so we can just write that down first. Since acquisition is happening in the middle of the year, the profits are calculated as under. Okay. Balance on 1420X1. This is given to you 60,000 and इसमें कोई doubt नहीं है कि ये pre है. So this is my pre-acquisition profit. Okay. Then I will have to add profits for 20X1, X2. How much I earned, I do not know, because I still have some adjustments that are going to come out of this. Okay, less. Somewhere I'm having a dividend that is being paid. So a dividend of 10% was paid on 1st November. All right. So 10% means 10% of what? 10% will always be on the equity share capital of 4 lakhs. So less dividend paid. 4 lakhs into 10%. This is paid on 1/11. $40,000. And इसके बाद what you are getting is the closing balance. Balance on 31st March 20X2. Balance on 31st March 20X2. Is it okay? Yes. So now the profit earned will be just a balancing figure. The profit earned will be just a balancing figure. 1,44,000. 1,44,000. All right. Is it okay? Till now, any doubts or is it okay so far? All clear? Kaushiki is not to be seen. Is she there? Nidhi Deshpande, are you there? Shailendra, are you there? No doubts. Okay. Can I say that this 1,44,000 is entirely post? Answer is no, you cannot. Because you have acquired in the middle of the year. You have acquired in the middle of the year, exactly in the middle of the year. So 6 months profit is going to be pre-acquisition. 6 months profit is going to be post-acquisition. Okay. Pre 6 months, post 6 months. Okay. All right. So you will be having a split between 6 months profit. Okay. In between, I am becoming a Mr. India, but please bear with it. Okay. I think there is some voltage problem or something due to which the camera is flickering. Okay. So just bear with it. If there is a problem in the audio, let me know. Okay. All right. So this is my retained earnings. Okay. Now the question is, sir, this dividend which is paid, is it pre-acquisition or is it post-acquisition is what we have to answer. Look at the question's wordings. The retained earnings of Krishan Limited showed a credit balance of 60,000 on 1st April, out of which a dividend of 10% was paid. Out of which a dividend of 10% was paid. That means now you tell me, is this dividend out of pre-acquisition profits or is it out of post-acquisition profits? Go ahead. Tell me, is it out of pre-acquisition or is it out of post-acquisition profits? Obviously, it is out of pre. The wordings are saying clearly that you are having dividends which is paid out of the balance on 1st April 20x1. That means it becomes a pre-acquisition profit. So we'll just write that fact. This is only for you. You don't have to put this in your examinations. Okay. Since the question specifies that dividend is out of the balance on 1st April 20x1, comma, it is clearly pre-acquisition dividend. It is clearly pre-acquisition dividend. Excellent. All right. Okay. Specifically, it is telling. Okay. If the question was silent, agar question chup hota, it would not tell the source of these dividends. Then what you could do, you could assume in that case that it is out of post-acquisition profits. In that case, you could assume that it is out of post-acquisition profits. But in this case, it specifically says, so therefore it is pre-acquisition dividend. Moreover, what happens is the dividend is declared on 1st November and it is paid on 1st November. So therefore, Ram Limited is going to receive this dividend. Okay. The question is, where should Ram Limited credit this dividend? Should it credit it to the profit and loss? We answer this question carefully. should this dividend be taken by RAM Limited to the profit and loss, or should this be taken as a credit to the investment? Subsidiary gave the dividend, parent received the dividend. It is pre-acquisition dividend. Where should this dividend go? Should this dividend be recorded as income, or should it be taken as an adjustment against the cost of investment? Yes? Anybody? It should be taken to income. It should be taken to income. Don't go in AS 13 and say that, sir, this is pre-acquisition. All pre-acquisition dividend, pre-acquisition interests are credited to the investment account. वो AS का बात हो गया. That is accounting standards. Please don't confuse Ind AS. The question specifies that it is taken to the retained earnings. Okay. Ram has credited the dividend to its retained earnings, means it is taken to the profit. So therefore, it is correct. This is correct. This is correct. Please don't do any adjustment for this. Okay. You have over enthusiastic students who say that, sir, pre-acquisition hai, take it against cost. No. Ind AS 109 tells any distributions or earnings from your investments or financial instruments should be credited to your P&L. So this treatment is correct. It requires no further adjustment. Okay. So now we come with the actual splitting that will happen. Okay. So here we have retained earnings, 1,64,000. Split this up between pre and post. How do I get my pre? Balance on 1st April 20x1, 60,000. Add. I'll change the color for this because here students can make a mistake. 6 months profit. Which 6 months? 1st April x1 to 30th September x1. So that would be how much? 1,44,000 into 6 by 12. Sir, 1,44,000 kahan se aaya? This figure. Okay. Profit for x1, x2. 72,000. Correct? And now we do the split. We do the dividend distribution here. It is pre. So less dividend. Less dividend, 40,000. So that leaves you with how much? 60 plus 72 minus 40 leaves you with 92,000. 92,000. Okay. Next, I am having post. Post mein it is only 6 months profit, nothing else. $72,000. So this is how the split is going to work. This is how the split is going to work. Okay. All right. All clear. Have you understood till now? Have you understood till now? Yes. Is it clear? All right. All clear. Excellent. So then let us move on to the next part. The moment you see a pre-acquisition dividend adjustment, your brains should tell you from behind, we will have to do the adjusting entry. If we don't do the adjusting entry, what would happen is my goodwill will start getting affected. So let us pass the adjusting entry and give the effects also immediately. Okay. So what will be the adjusting entry? I have to pull it out from the consolidated P&L and I have to take it to the goodwill. That means the cost of control account. So here the entry will be consolidated P&L debit to cost of control. To cost of control. Is it the entire 40,000? 40,000? No. भाई जितना parent का share है सिर्फ उतना. NCI is paid off already. So NCI is already reduced by this. Okay. So this is going to be 40,000 into 60%. 24,000. 24,000. So this goes working note 1. This goes working note 2. Are, do you remember this adjustment entry? Do you guys remember this adjustment entry? Entire last class we had discussed this. Yes. All right, good. So then give the effect to this immediately, because there is a high possibility that you will end up going wrong only in this. Rest all you will be able to manage. So go to consolidated other equity. You have standalone of RAM Limited. There you record less pre-acquisition dividend. Working note 5. 24,000. 24,000. And then credit it to cost of control. By consolidated retained earnings, working note 5, 24,000. This is pre-acquisition dividend. This is your pre-acquisition dividend. All clear? Yes. The next part now. Now it is a normal question. अब तो कुछ नहीं करना है. Now you just have the fair value adjustments that need to be given impact to. Okay. Now look at the fair value data which is given. You are given the fair value, the balance sheet book values as on 31st March 20x2. This is the book values. You are given the fair value as on which date? You are given the fair value as on 31st on 1st October 20x1. Same is here also. Value of plant and machinery as on 1st October was 4 lakhs. In case of dividend declared but not paid, no adjustment to be made. You can choose not to make. Okay, you can choose not to make, but you won't get that, because when, see, if you declare the dividend and not pay, then NCI would not be impacted. Okay, so there is no need for an adjustment. Ideally, you will be having an entry in the subsidiaries books. Ideally, you will be having that entry in the subsidiaries books. All right. So if you vote to show a receivable in the parents books, then you will have to do the adjusting entry. Okay. Then you will have to do the adjusting entry. All right. Okay, so that takes care of dividend. Now we come to this one. Can I say that land and building 3,60,000, plant and machinery 4 lakhs? So can I directly say 4 lakh and 2 lakh 70? The difference is how much? 1 lakh 30. Can I say 1 lakh 30 is the surplus on account of revaluation? Answer is no. This would have been depreciated. This would have been depreciated over the year. So you will have to start with the balance on 1st April, calculate the 6 months depreciation, determine the balance, and then move on to compare it with the fair value and take the impact. You cannot directly do the deduction here, okay, because the dates are different. Okay, so now coming to fair value adjustments, this will be my initial adjustment. Okay, one second. Initial adjustment. Okay, now see, to compute the fair value adjustment for plant and machinery, comma, we need to determine carrying amount of plant and machinery on 1st October 20x1. So how do we determine that? Well, it looks something like this. 1st April 20x1, I don't know the value. Less 6 months depreciation. 6 months depreciation. Sorry, this is a balancing figure. That gives you balance on 1st October 20x1. So how do I do that? Let us assume that the opening value was 100. We are depreciating it at which rate? We are depreciating this at the rate of 1 second, 1 second, 1 minute. 1 minute, please. Less depreciation for x1, x2, balance on 31st March x2. Let us assume that the value was 100. The depreciation rate on plant and machinery is 10%. So I'm left with 90. This 90 corresponds to 2,70,000. So you just do a cross multiplication. Okay. So if this is 2,70,000, this will be 30,000 and this will be 3 lakhs. So this is the value on 1st April x1, and then we proceed to calculate the 6 months depreciation and the value. Okay, so far you just copy this, then we shall proceed to the next. Then we shall proceed to the next item. Have you understood this part? Have you understood this? Did you understand this? All right. So then let us move on to the next part. Now see. Balance on 1420x1 3 lakhs less 6 months depreciation 15,000. 30,000 into 6 by 12. 2,85,000. This is balance on 11020x1. Fair value on 11020x1 is given to be 4 lakhs. Given. Therefore, increase in value of plant and machinery 1,15,000. This is nothing but 4 lakh minus 2,85,000. Is it understood? Yes. Clear? Okay. Shall we proceed further? Shall we proceed further? Okay. All done. So then let us move on to the next. Okay. In respect of other items, the changes in fair values are already given. And hence the adjusting entry would be C. Are you given this? Yes. Following are the increases on comparison of fair value. This is not the fair value. This is the movement in fair value. Movement in value. Okay. So don't think that this is the closing fair value. This is the movement in the fair value. So trade payables 20,000, land and building 2 lakhs and inventories 30,000. So ये movement है. So we take it directly as an adjusting entry. Plant and machinery debit 1,15,000. Land and building debit was 2 lakhs. Inventories upward 30,000. Trade payables also has gone up by how much? 20,000. So the difference will go to pre-retained earnings. Three lakh 25,000. Three lakh 25,000. Is it okay? So where will these go? This will go in note 1. This also in note 1. And pre-retained earnings would go to working note 4. Would go to working note 4. Okay. So give the effects. Go to your note number 1. Here you will be having land and building going up by 2 lakhs. Plant and machinery going up by 1,15,000. Inventory going up by 30,000. Trade payables going up by 20,000. Trade payables going up by 20,000. Okay. So that takes care of first part. The second part would be add it in your retained earnings. Add it in your retained earnings. Okay. Add. Fair value adjustment. Working note 6. 3,25,000. 3,25,000. Okay. Since I have an upward fair valuation, do you think I will be having a subsequent adjustment? Yes, only in respect of plant and machinery because the rate of depreciation is given. Do I have a fair value subsequent adjustment for inventories and trade receivables? Inventories and trade payables? Answer is no, because they've specifically said that inventories are unsold, trade payables remain unpaid. If they were to be paid off or sold, we would pass the reversing entry. We would reverse it through the post acquisition profits. I hope you remember we had done these adjustments long time ago. Okay, so we will be doing no adjustment for that, but we will have to compute the additional depreciation. Further, land and building pay additional depreciation cannot be calculated because neither are we given the remaining useful life, nor am I given the rate of depreciation for land and building. So we cannot calculate that. So what we will be calculating is only the additional depreciation to plant and machinery. Okay. So coming to the next part, B, subsequent adjustments. Subsequent adjustments. Depreciation as per fair value. 4 lakhs into 10% into 6 by 12. 1st October X1 to 31st March X2. This is 20,000. Less depreciation based on book value. The total depreciation was 30,000, but we have to take it for 6 months. So this will be 15,000. This will be 5,000 additional depreciation. $5,000. So what will be the entry for this? Post retained earnings debit to plant and machinery 5,000. Where will this go? Working note 4. This will go in note 1. Okay. We'll also write that land and building cannot be computed first part. Okay. In absence of information such as rate of depreciation or remaining useful life, comma, land and building is not depreciated. Okay, so since this data is not given, we cannot. Okay, and it is fine also not to depreciate, because we can always say that the increase is attributable to increase in the value of land, and land in itself is a non-depreciable asset. Okay, so give the effects. Post acquisition, right? So post acquisition goes in your working note 4. In your working note 4, you will be having less additional depreciation, 5,000. Okay. All right. Now suppose they had to give that those trade payables would be paid off, etc. Which 30,000? What 30,000? Where is that 30? You are telling this journal entry, then it should come from here. Increase in value of inventories 30,000. Okay. I think you're talking about inventories. Okay. So 5,000, we have given this adjustment, and let us give the adjustment in here also. Plant and machinery minus 5,000. Minus 5,000. I hope that 30,000 is clear, Srishti. Yes. Okay. So ye ho gaya. Okay. We'll just write one extra point saying that if the trade payable was paid and if the inventory was sold, what would be the entry to pass? Okay. If it is given, this is not a part of the answer. If it is given that inventory is sold and trade payable is paid off, the following adjustments would be required. What is the further adjustment? Okay, I'll explain that 30,000. Just give me a minute. Inventory sold, paid off. So here the entry will be post P&L debit 30,000 to inventory. And this would be, you are paying it off. So trade payables debit 30,000 to post, this is 20, sorry, P&L 20. Okay, so this would be your adjusting entry. Okay, all right. Now you are asking, Srishti, where did this 30,000 come from? This is full year depreciation, no? See, this is the depreciation figure which we have calculated here. Depreciation for X1, X2. So 6 months of that is 30,000 into full year depreciation. So 6 months of that will be 30,000 into 6 by 12. Okay. All right. ये हो गया, सब कुछ हो गया. So now what all we need to do? First thing is complete working note 4, distribute it. NCI, this is going to be 60% and 40%, right? So 4,17,000 into 60%, 250, 200. Yes, that is what I am also doing. Okay. $67,000 if I split. Working note 3. So do the postings. We start with NCI. by pre-retained earnings working note 6 post retained earnings working note 6 प्री का कितना था 1,66,800 पोस्ट का कितना था 26,800 pre-retained earnings also goes to cost of control retained earnings 250 200 2,50,200 post retained earnings will be added here add retained earnings of Christian Limited working note 6 not 6 sorry this is 4 all these are working notes 4 only my mistake so this is kitna tha 40,200 working note 4 working note 4 okay all right fine so that completes everything so balance total up your NCI 62,40 plus 433,600 to balance carry down balance your cost of control minus 165,800 goodwill 1,30,600 retained earnings 6 lakhs so 7,30,600 okay the remaining things let us add them up now it's usual now 60. Please post them here. $17,20,000. Then goodwill is 165,800. Inventories 342,800. Other equity, NCI, trade payables, and short-term borrowings. Okay, so that concludes a huge question. It would taken 1 hour to complete it. Okay, all right, fine. Excellent, Soham. Good. Okay, so that is the end of that question. Any doubts, anyone? So we are clear with dividend entirely now. Any doubts, Rishti, Soham, Rashmi, Sumit Jain, Shailendra? That's it. All clear. Great. Okay, fine. So that's the end of dividend. Okay. What I want from you now is try question 9 by yourself. Okay. Question 8 we did. Question 9, dekho, same question. Only thing is 100% shares acquired on 1st October, 31st March, same balance sheets, land, building, inventory, trade receivables, other reserves, equity capital, bank OD, trade payables. Retained earnings showed a credit balance of 3 lakhs on 1st April, out of which a dividend of 10% was paid. Same like the last problem. DEF recognized the dividend in the P&L. It was retained earnings there, it's P&L here. Fair value of P&M on 1st October was 20 lakhs. We had the same thing there at 4 lakhs. Rate of depreciation 10%. Increases on comparison, trade payables, land and buildings, inventories. Okay. It may be assumed that inventory is still unsold. Assume other reserves are the same. All fair value adjustments have not yet started impacting the post-acquisition profits. Okay. So when that is done, it's the same question like the previous one. So please try this for homework. Koi change nahi, kuch bhi nahi, sab kuch same to same. Okay. So you will be trying this question out by yourself. Okay. All right, so that is taking care of question number 9. Okay. All right, so dividend is done. Okay. All right. 1 minute, just give me a minute, please. Okay. Stake sale. Okay. All right. See, in your syllabus, which is there, stake bonus shares issued by the subsidiary, that is not specifically mentioned. Okay. So that is the reason I haven't included it in the notes as well. Okay. That is the reason I haven't included it in the notes. Maybe if time permits, I will do it towards the end of today's session. Okay, first let us complete whatever things are there in the syllabus. Then we shall take the last one. Then we shall take it if time permits. Chota sa adjustment hai, you will all be able to do it quickly. You will all be able to do it quickly. Let us see if I have time to pull in another question or I leave it for homework. It's just, okay, 31 questions. We'll do it as later on or I'll leave it for homework. Okay, all right. So question 8 is done. We come to the next part of our discussion. Three aspects are remaining now. First one is additional. Okay, sir, can a question about different accounting policies between the parent and the subsidiary come in the examination? Could come, but I haven't seen so far. Okay, could come, like for example, parent may be following weighted average, whereas subsidiary may be following FIFO. So then you will have to see if they are the same class of inventory, subsidiaries policy will have to change. And because of change in subsidiaries policy, you will have to give the impact retrospectively. And then with the restated balance sheet, you will have to do the consolidation. Okay, that is how you will have it. It's very unlikely, even practically also. Okay, so see, practically it's difficult because you are almost always going to ensure the subsidiary aligns its accounting policies in line with that of the parent prior to acquisition. Okay, that is what will be ensured. So when you do the acquisition, the policies would be aligned. So it's practically not going to be an issue. Okay, so coming to the next part, we have three parts left now: stake purchase, additional stake purchase, stake sale, and last one is chain holding. Okay, so I will be doing the first two before giving you a break, that is stake purchase and stake sale. We take a break, then we will do chain holding. Chain holding should take considerable time because वो थोड़ा सा tricky है. And once this is done, if time permits, I will just introduce you to the bonus adjustment, and one question is left which I will see if I can explain the main points, and then we should be in a position to conclude consolidation. Okay, so now coming to additional stake purchase, see, let us start with an example. Okay, because I would go ahead with an example and then visit the theory that we have discussed, we have written down, so that it becomes clear to you. Okay, so now additional stake, when you already have a controlling stake, two things can happen when you have additional stake purchase. Additional stake gives control, and second one is additional stake acquired after obtaining control. There is a huge difference between both of them. Don't get confused. This is, say you had a 20% stake and you acquired a further 40% to give you 60%. Whereas here you already had 60%, you acquire another 20% to give you 80%. In the first case, you are not preparing consolidated financials because वो तुम्हारा subsidiary है ही नहीं. In the second case, you are already consolidating and thereafter you are acquiring an additional stake. So I will start my discussion with this one. Additional stake is acquired after obtaining the control. This we have already done. I will tell you where we have done it. You will also be able to recollect. Okay. So now additional stake acquired after obtaining control. Okay. So let us assume that 1st April 2020. P acquired 60% stake in S for rupees 7,500. Okay, for 7,500. Net assets on 1/4/2020 of S is equal to rupees 10,000. Okay, so these are the facts given. So if I have to calculate the goodwill, it is fairly simple. PC for 60% is 7,500. Add NCI at 60% stake, 10,000 into 60, 10,000 into 40%, not 60, 40%. So this would be 4,000. So this would give 11,500 less net assets 10,000. So we are left with 1,500. This is your goodwill, which you will be recognizing on acquisition. Okay. Your post-acquisition profits. (1/4/2020) to 31st March 2022. Post profits are how much? Let us assume that post profits are 5,000. So parent stake will be 60%, that is 3,000. Subsidiary stake will be 40%, that is 2,000. Therefore, net assets on 31/3/2022. Opening कितना था? 10,000. Profit kamaya, so that gets added to net assets. So this is 15,000. This is 15,000. Therefore, NCI on this date could be taken as 15,000 into 40%, that is 6,000. You can do it this way, or NCI is equal to opening date 4,000 plus share in profits kitna tha? 2,000. So that also comes to 6,000. Are you okay with the facts of the question so far? Yes. On 1st April 22, P acquires additional 20% stake for 3,500. Have you understood the fact so far? Yes. Goodwill calculation, NCI calculation. Is this clear to you? I haven't done anything out of the box. Okay. Is it clear so far? I need you to understand this background before moving to stake purchase. Okay. अभी तक तो clear है ना? All right. So then we move on to the next part. P acquires additional stake for 3,500. So let us talk about standalone financials. Standalone financials of P. The parent जब खरीदा था initially 1/4/2020 में खरीदा ना? Yes. When it purchased in 1/4/2020, it would have passed the entry investment in S debit to bank 7,500. Fair enough. And Ind AS 27 gives you an option to record the investment in a subsidiary, associate, joint venture at cost. So 7,500 will be considered here. Okay. Now, 1422 when it makes additional investment in subsidiary debit to bank. It will pass the same entry. 3,500, 3,500. This is the story as far as the standalone financials are concerned. Now, when you talk about consolidated financial statements, देखो पैसा तो जा रहा है, money is going out from the group, so you will be crediting the bank account. The question is, which account will I debit? I will give you some options. You will tell me which one is correct. First option, sir, we are making additional investment. So consolidated financial statements also you debit the investments. So the first option is, sir, we will debit investment in S. All right. The second option, sir, investment in S is actually a representative of the net assets. So therefore, we will again consolidate the net assets. So the second option is, we will replace it with net assets of S, which is like how we are already doing for consolidation. The third option, sir, goodwill hai, we will do the goodwill debit only, because this is adding to our cost of acquisition. So we will debit it to goodwill. The fourth option is, sir, we will debit it to NCI. The fifth option, you will tell me anything other than the above. But I don't think fifth option exists, because we have covered everything that is there to cover. इसके अलावा कुछ बचता ही नहीं है. All right. So now you tell me, what are you going to debit in the consolidated financial statements? Investments in S, net assets of S, goodwill, NCI, or anything else. For example, sir, we'll debit the reserves. We'll debit the consolidated P&L. Okay. So what do you think? क्या debit होना चाहिए? Two people are saying net assets. One person is saying goodwill. Others? Any other answer? Soham? No other answer. All right. Let us start looking at each option and understanding what is the right one. First one, investment in the subsidiary. Sir, this will never come, because consolidated financial statements is parent plus subsidiary presented together as a single entity, and a single entity cannot invest in itself. So therefore, investment in S to aega hi nahi. Investment in S will never come. Okay, so this is the first point. Why we cannot debit investment in subsidiary? Nobody gave this answer, which is good. At least we are aware of the fact that investment in subsidiary cannot come. Coming to the next aspect, net assets of the subsidiary. Sir, net assets of the subsidiary, हम लोग already consider कर चुके. We have already considered by consolidating the net assets. See what I told you. Initially, I acquired 60% stake. That means in my balance sheets for the year 31st March 21, as well as for the year 31st March 22, I am already consolidating 100% net assets line by line. I am already consolidating 100% net assets line by line. अभी question किया हमने. So therefore, ये जो line by line consolidation है, this is happening right from the date of acquisition. So March 21, March 22, already 100% of the net assets are consolidated. They are added entirely. So now the question is, you answer, अगर 100% of net assets are already consolidated, फिर से कैसे आ सकता है ये? How can I record it again? How can I record it again? Yes, I'm already recording 100% net assets. कुछ बचता है क्या इसके बाद? After 100%, do I have another set of net assets acquiring? Answer is no, you don't have. Already all the assets you have consolidated, all the liabilities you have recorded. So there is nothing left to add. And that is why net assets of S is not right. That is why net assets of S is not right. दो ऑप्शन चले गए. Third option, goodwill. I had told you once upon a time that goodwill arises only in one case in the entire Ind AS, and that is business combination. And in business combination, what is essential is you should have acquired control. You should have acquired control. Sir, did you acquire control on 1/4/2020? Or did you acquire control on 1/4/2022 when you purchased extra 20% stake? You will say, sir, we acquired control on 1/4/2020. So when you acquired control on 1/4/2020, you tell me, is it practical to say that I have acquired additional control on 1st April 22? Is this additional 20% making you control more efficiently, or is it strengthening your control, or is this additional 20% only giving you a share in extra profits, an extra share in the profits? Tell me, this additional 20%, how are you going to view it? Is it giving extra control, or is it giving you just extra share of profits? It is giving me an extra share of profits. भाई पहले से ही आप पूरा कंट्रोल कर रहे थे. You are already controlling the entity entirely. So therefore, extra share of profits will not arise only in this case. Extra share of profits will not arise only in this case, and therefore, if control cannot arise, only extra share of profits will arise. So when control does not arise only in this case, extra control nahi hota hai, Sumit. Extra control nahi hoga because you are already controlling the entity. When you are already having a controlling stake, आप ज्यादा एक्वायर करोगे तो आपको ज्यादा कंट्रोल नहीं आएगा. See, Mukesh Ambani is already controlling Reliance. अभी आपके 10 शेयर रिलायंस मुकेश अंबानी ने खरीदे. डू यू थिंक ही इज गोइंग टू गेट एक्स्ट्रा कंट्रोल ओवर द एंटिटी? आंसर इज नो, ही वोंट. उसको कुछ फर्क भी नहीं पड़ता है व्हाट एवर ही डज विद द एक्स्ट्रा शेयर्स. ओके, ही हैज सोल्ड, रिलायंस हैज सोल्ड 10% stake in Jio to Google. Now if it acquires the shares back, do you think Reliance will have more control over Jio? नहीं, आज भी जो stake है, that is sufficient to give control. So therefore, Reliance is not going to get extra control. What it will get is only extra profit. तो जब extra control नहीं आएगा, there is no control, then that means there is no business combination. And when there is no business combination, there cannot be a goodwill. And that is why the third option of goodwill is also eliminated. You can record goodwill only if there is an acquisition. यहाँ पे acquisition नहीं हो रहा है. Acquisition had already happened on 1st April 2020 when you got the control the first time. After that, there has been no loss of control. So therefore, you will not recognize it in the goodwill. तो बचा कौन सा? सर बचा तो NCI है. So why will I debit my NCI? Why will I debit my NCI? This is logical. ये देखो, in this case, your NCI had a credit of 40% stake. It had a credit of 40% stake. After you acquire additional 20%, NCI will drop to 20%. Do you agree to this? Yes. So if NCI was already having a credit of 40, and after that it will have a credit of 20 only because it has sold its stake to the parent, what do you think the debit should go? The debit will obviously go to the NCI. The debit will obviously go to the NCI. Okay, so this is the right answer. It is like you are purchasing additional profit share from the non-controlling interest. It is like you are purchasing an extra share of profits from the non-controlling interest. Is it okay? Yes. Is it fine? Yes. And that is why NCI will be debited. That is why NCI will be debited. आपको समझा why NCI is going to get debited? Yes. Did you understand why NCI is going to get debited? Yes. All right. Now, किस amount से debit करोगे? Sir, account तो समझा. I have two options. NCI debit. What am I going to debit NCI with? I have two options. First one, amount paid, that is 3,500. The second case is NCI had a value of 6,000 when you made an offer for purchasing. So 6,000 divided by NCI stake was how much? NCI stake was 40%. And now you are acquiring 20% from them. So ultimately, NCI is sacrificing 3,000. Ultimately, NCI is sacrificing 3,000 of its net assets. So now, what amount are you going to debit NCI with? Will you debit 3,500, the amount paid to the NCI, or will you debit 3,000, the loss of net assets which are attributable to the NCI? कौन सा अमाउंट आप डेबिट करोगे? Okay. Which amount will you debit NCI with? Come on. अब तो बोलो. All right. The second option, that is the sacrificing amount of 3,000. The second option, that is the sacrificing amount of 3,000. All right. 3,000. Sorry. Okay. Shailendra is saying 3,500 and Sumit also is saying 3,500. 3,500 nahi hoga because you are acquiring stake of NCI. You are acquiring stake of NCI. That means after you acquire, NCI will no longer have this 6,000 share in net assets attributable to them. ये 6,000 net assets उनको जाएगा नहीं. What will be attributable to the NCI will only be 3,000. What will be attributable to the NCI will only be 3,000. So therefore, you cannot debit 3,500. So your journal entry looks something like this. NCI debit 3,000 to bank 3,500. The question is, where is this difference going to go? Where is this difference going to go? First option. Sir, we'll take it to goodwill. We'll take it to goodwill. I purchased an extra 20% stake and I overpaid for it. I overpaid for it and therefore I will take it to goodwill. Second option, I will take it to profit and loss account. I will take it to profit and loss account. It is an overpayment. I will treat it as a loss. Third option, I will adjust in reserves. I will adjust in reserves. That means other equity. I will adjust in other equity. So now what I want you to tell me is, in तीनों में से which option are you going to follow? Which option are you going to follow? Are you able to follow Shailendra Sumit? Why we cannot take 3,500? Because NCI stake won't go down by 3,500. NCI stake will only go down by 3,000. NCI stake will only go down by 3,000 and therefore, okay. So now the question is, sir, which amount, this 500 excess which you have paid, which account are you going to debit? Can you debit goodwill? Because you will say, I got net assets attributable to me extra worth 3,000 and I paid 3,500. So 500 is goodwill. Second one is, I will debit P&L because this is extra payment made. Third option is, we will take it to other equity. Let us again look one by one. None of you answered goodwill, which is very good. Goodwill is for acquiring control. Here I am not acquiring control, so I cannot take it to goodwill. I am left with only two options, P&L or adjust in other equity. You remember long ago, you had studied partnership accounts. You had studied partnership accounts. Okay. In partnership accounts, अभी याद भी नहीं रहेगा अपने को. In partnership accounts, there would be purchase of share from another partner. Purchase from another partner. You remember you used to calculate something known as gain ratio, something known as sacrifice ratio. कुछ याद है आपको? थोड़ा याद है तो भी चलेगा. Do you remember this? Yes. You used to calculate which partner is gaining. You used to record which partner is sacrificing. कुछ याद आ रहा है? Yes. Okay. थोड़ा सा काफी है. Okay. And then what you used to do, you used to record any surplus. उसको हम लोग goodwill कह के बोलते थे, which was not right, but I will take you back to that goodwill. Okay. I used to calculate the goodwill because existing partners, now this is intermediate language. Don't ever say that Aditya sir has taught us this. This is for giving you a comparison between why I cannot debit the P&L, why I have to debit other equity. ये clear हो गया ना? I think you will be fairly conversant with consolidation, stake sale and stake purchase. Okay. See, you used to calculate goodwill by using those methods. वो super profit, average profit, annuity, पता नहीं कौन सा method था. When you used to calculate the goodwill, you would do one thing. You would raise the goodwill in old ratio. अरे यार क्या हो गया इसको? 1 second. Okay. You would raise the goodwill in the old ratio and write off the goodwill in the new ratio. थोड़ा याद आ रहा है? Yes. Are you able to recollect a little bit? What you would do, you would raise goodwill in old ratio, write off goodwill in new ratio. Ultimately, कुछ पार्टनर्स का डेबिट आता था नेट, some partners would come as credit, and this net debit and credit, you would route it through partners capital account. And if they had a current account separately, you would route it through the current account. ऐसे करते थे. But you never used to route it through the profit and loss account of the firm. You never used to route this difference through the profit and loss account of the firm. Sir, why was this the case? Why was this the case? This was the case because this is an owner to owner transaction. This is an owner to owner transaction. In an owner to owner transaction, you will never record the movement, the gains or loss through the profit and loss, because the profit and loss account is purely a transaction. The profit and loss is purely a transaction. Between whom? It is a transaction between the entity and the outsiders. The P&L is a measurement of your results of operations. You cannot operate within yourselves and make a profit. Your profit will always come from outsiders, and therefore owner to owner transactions would be routed through the capital account ownership. Now we come back to the same concept in holding and subsidiary. I'm having an entity subsidiary. One is the parent. Can I say that in a very crude sense? Okay. Can I say that P and NCI are partners in the subsidiary? Yes or no? Can I say that the parent and the NCI are partners in the subsidiary? So in our example, the parent had a 60% stake. The NCI had a 40% stake. That means they are essentially kind of partners in the business. They are kind of partners in the business. They are not, because in a partnership, what happens? Both the partners have to take the decision. Okay. But in this case, the control lies entirely with P. So that is why I'm saying don't take it to be a partnership firm. Okay. It's not a partnership firm, but I'm drawing the concept from the partnership firm that you have understood. So when parent purchases 20%, the NCI sacrifices 20%. So when this purchase and sacrifice is happening, obviously it cannot be routed through the capital account because it is an owner to owner transaction. It is an owner to owner transaction. जैसे यहाँ पे the difference on goodwill raise and write off in the old and new ratio is routed through the partner's capital. Similarly, here I cannot record any surplus or short payment which I have made in the P&L because this is not a transaction with the outsiders. This is a transaction with my fellow partner, and therefore I will route it through other equity. I will route it through other equity. Is it okay? Have you understood this part? Clear? We cannot take it to the profit and loss account because I am purchasing this from another owner. I am purchasing a stake from an existing owner. It will be an owner to owner transaction. Okay. And now please forget that we ever discussed about partnership accounts. Okay. Bhul jao. It was a very limited discussion. Okay. So forget all this. We will never see partnership accounts again in CA final at least. Okay. तो इसको भूल जाइए आप. All right. And then ultimately we are left with the option that it has to be routed through other equity. It has to be routed through other equity. All right. So this is the treatment when you have made an additional stake purchase. When you have made an additional stake purchase. Okay. Sir, what if I did not have a control initially? Then I acquired certain shares, and that acquisition gave me control. This we have discussed, as Soham also had said, in Ind AS 103. We had discussed this in Ind AS 103. Remember, existing investment will be fair valued, and the gain or loss on the fair value measurement will be taken to the P&L. And after this, what I would do is I would do the business combination. So this is what you mean by additional stake purchase giving rise to a control. So therefore, if you look at the additional stake purchase theory, you are going to look something like this. Additional stake results in control. For example, 10% existing plus 70% additional. This is not covered under 110. This is covered under 103. So remeasure existing stake at fair value. The difference is taken to the P&L. Take over the net assets, create goodwill and NCI, eliminate the existing investments is what you are going to do. And this is Ind AS 103. The second option is what we saw just now, additional stake acquired after you already have the control. So 70% existing plus 10% additional. This is going to be covered under 110. Treat it as a purchase of NCI in the consolidated financial statements. No additional net assets are taken over, as 100% of net assets would already be recorded. Proportionate NCI on the date of additional stake is to be debited. So based on net assets, if data is given, if net assets data is not given, how are you going to record? Okay. So proportionate NCI. What do you mean by proportionate NCI? Suppose if the net assets data is given. In our question, the net assets attributed to NCI was 6,000. So if you are following the partial goodwill method, the net assets will exclude the goodwill. In our case, which method did we follow, sir? In our case, we followed partial goodwill. See, I have taken NCI based on what? Based on 10,000 into 40%. 10,000 into 40%. So therefore, this is NCI at proportionate share of net assets. So therefore, goodwill is never attributable to the NCI in this case. Goodwill is never attributable to the NCI. By NCI will lose only that amount over which which is attributable to it. So in partial goodwill method, goodwill is not attributable to the NCI at all. What is attributable is only net assets. So it will only give the stake of net assets to the acquiring parent, Okay. So partial goodwill you will give based on net assets excluding the goodwill. Okay. If it is a full goodwill approach, the net assets will include the goodwill and then you allot it to the parent. That much is the loss of the NCI. So what you will be having is NCI account debit to bank credit. It will give a difference, that is a balancing figure, which is a loss on purchase of NCI. Gain bhi ho sakta hai. There could be possibility of a gain as well. So that will be debited to other equity. If net assets data is not given, you will be given current NCI values. Take proportion of that and plug it in the debit. Okay. Why am I not adjusting through P&L? Because they are owners and therefore any gain or loss would be treated as a part of my equity transactions. It will be routed through the equity. Have you understood? Yes. Have you understood completely? Yes. Any doubts? No doubts? All clear? सृष्टि, शैलेंद्र, सुमित, आप सभी को समझ में आ गया है? Yes. Did you understand? All clear. Okay. So we look at one or two questions now on stake purchase. Chota sa topic hai. You don't have to do any balance sheet or kind of stuff. Okay. So we come to finally the first question. We come to the first question. Okay. This is on stake purchase. A acquired 10% additional shares of its 70% subsidiary. So this is the second option. The following relevant information is available in respect of the change in NCI on the basis of balance sheet finalized as on 1st April X0. Separate financials, you are having investment in subsidiary 70% interest at cost 14,000. Purchase price for extra 10% interest is 2,600. So this becomes important. CFS, your NCI at a 30% stake is 6,600. Consolidated P&L amount is 2,000. Goodwill amount is 600. The reporting date of the subsidiary and the parent is March X0. Prepare a note showing adjustment for change of non-controlling interest should the goodwill be adjusted. So goodwill will not be adjusted. You don't have to do any adjustment to the goodwill. Okay. So now we pick up the question. Additional stake purchase. So NCI would be debited. But kitne se? Kitne se? So if you look at the question, NCI is 6,600 for 30%. You are acquiring extra 10%. You are acquiring extra 10%. So 6,600 is for 30%. You are acquiring 10%. So this gives you how much? This gives you 2,200. To bank. How much are you paying? Sir, I am paying 2,600. 2,600. So debit of 400 will go to other equity. Loss on purchase of NCI. Loss on purchase of NCI. Is it okay? Yes, so that completes question 1. Can I take it to goodwill? Answer is no, because control already existed. You will not create control again. You will not create control again. So that is not permissible. So that takes care of question 1. That takes care of question 1. Okay. Now we move on to the next part. Question 2. Try to do question 2 for homework. Balance sheet hai, but it is very simple balance sheet. Kuch mat karo. Everything remains the same. Only thing what will change is in the group column. You will be having changes in other equity. You will be having your changes coming in other equity. Cash. That's it. Only these two changes are going to come. Nothing. Okay. So try this out by yourself. Okay. Or what I can do is, wait a minute. I'll try to do it. I'll do it very short in brief. You should be able to follow. A acquired 70% shares of B on 1st April X0 when the fair value of net assets was 200 lakhs. During X0 X1, B made a profit of 100 lakhs. Individual and consolidated balance sheets as on 31st March X1 are already given to you. So this is A, B, and this is your consolidated balance sheet. You don't have to prepare this. Goodwill, PPE, then you have investment, cash, other current assets, share capital, other equity, and non-controlling interest. Okay. So now the question is, A acquired another 10% stake in B on 14X1 at 32 lakhs. The proportionate carrying amount of NCI is 30 lakhs. Show the individual and consolidated balance sheet of the group immediately after change in NCI. So I am purchasing extra 10% by paying 32. The proportionate carrying amount is already given to you, that is to be 30 lakhs. So the entry that will be passed is NCI debit 30 to bank 32. This goes to other equity. This goes to other equity. Is it okay? Yes. So now if I talk about the standalone financials of A had investment appearing at 150, 150 निकल के बन जाएगा 182. 150 निकलेगा, it will become 182 because I am adding investment worth 32 lakhs and it is going to be paid obviously. So 200 minus 32, this will come to 168. This will come to 168. Rest all items remain the same in the standalone. Sir, B Limited standalone will change because of purchase? No, it won't. It is going to the owners of B Limited, the NCI of B Limited. So B Limited's balance sheet is not going to change on account of this transaction. Coming to the consolidated balance sheet. One thing is sure, this cash balance has changed. It has become 198. Cash balance has changed. It has become 198. NCI would have changed. 90 is becoming 60. You can see NCI debit 30. So 90 becomes 60 and 870 will go and become 868. Why? This loss of other equity of 2 will be taken to other equity, 868. So that is the only change which is there as far as the standalone and group balance sheets are concerned. Rest nothing is there. So that concludes your stake purchase. Is it okay? Have you understood stake purchase? Yes. Have you understood this question which we did just now? Yes, I basically plugged in the amounts. Otherwise, there is nothing else to do. Have you understood the question and the answer? Yes, all right, fine. So we then move on to the next part, that is, you can read this changes in the consolidation process on purchase of additional stake. You can read this. You should be in a position to understand. So far, questions haven't come on this. Okay. This is like purchase of additional stake. Okay. Purchase of additional stake. How to do the consolidation. Okay. So far you have not received any question. It's not there also in the study module. So I have also not included anything from there in the session. Okay. So can go through it. It should be fine with you. Okay. Coming to the next part, that is stake sale, which is important. Now what I want from you is, should I continue it now or do I give a break and take it along with chain holding? बोलो, अभी ब्रेक चाहिए या फिर अभी करके उसके बाद हम लोग ब्रेक ले लेंगे? What do you want? I have to do chain holding in detail. Okay. I cannot avoid chain holding because it's come in examination for 3-4 times. Okay. So do you need a break now or can I postpone the break by 15-20 minutes? Sumit, tell me honestly, you need a break? I'll give you a 10-minute break. All right. कुछ लोगों को फर्क नहीं पड़ता है, ब्रेक दो ना दो. Okay. All right. It's 9. We take a break of 10 minutes. And then we will do it after the break. Okay. All right. So a 10-minute break. We resume at 9:10. It's 9 right now. We resume at 9:10. ठीक है? Okay. All right. So, yes. So welcome back, guys. So now we start with the next part, that is stake sale. And this is slightly, I mean, this is, a little tricky for one of the aspects. The other aspect is very simple. You will only be able to do that. Okay. So stake sale again gets divided into two parts. The first part is there is no loss of control. The second part is there is a loss of control. Okay. So what do you mean by loss of control and no loss of control? Okay. It's simple to understand. The first part, at least you will only tell me the answer because it's exactly the same like what we did last. Okay. So stake sale could be of two types. First one, I have a 95% existing stake and suppose I sold a 20% stake. So I have now with me 75%, but there is no loss of control. There is no loss of control. So therefore, how will we view it? This is same like I already had control. I acquired additional stake. So that case, it was purchase of non-controlling interest share. Here you are creating your non-controlling interest share. Here you are creating a non-controlling interest share. How am I going to do that? Well, you are going to get money because you are selling your share. So bank account debit. So bank account debit. This part is clear. Then you are creating NCI. At what amount we will discuss. You are going to create your non-controlling interest. The difference between these two will either be a loss or a gain, both of which will go under other equity. Reasons being the same as we discussed earlier. Reasons being the same as we discussed earlier. The only thing which we are left with to discuss is NCI. At what value is this going to appear? At what value is this going to appear? At least so far, is it clear? Yes. So far, are you able to understand? Yes. So far, is it okay? All right. So now, at what percentage will I create the NCI? At what percentage? See, I had the control. So therefore, net assets of S on the date of sale, this was attributable to me. Net assets of S on the date of sale plus your partial goodwill on the date of sale. This multiplied by additional NCI percentage which you have created. NCI will not be sacrificing. Here the parent is sacrificing. NCI is gaining. This is like subsidiary has two shareholders, parent and NCI. Parent sells and NCI acquires. So NCI is the entity gaining and the parent is the entity which is losing. So NCI is not sacrificing, NCI is gaining. That is why NCI is credited. In the earlier case, NCI was losing, so NCI was debited. Okay, so I hope that part is clear. Okay, now coming to the next part. This is how it looks like. So bank account debit to NCI. At what value will I create this? At what value will I create NCI? NCI will be created at this particular value. Okay. Net assets of the subsidiary on the date of stake sale. Net assets of subsidiary on the date of stake sale. That is the total assets. That is the total assets plus the partial goodwill on the date of sale. Plus the partial goodwill on the date of sale. This total we will multiply it by the extra percentage of NCI that you are creating. What is extra percentage of NCI? In this case, you can see you have sold 20%. You have sold 20%. So the extra NCI that you are creating is 20%. In this case, the extra NCI that you are creating is 20%. So this NCI will get the total net assets plus the partial goodwill share. Okay. Now, something to include on this partial goodwill aspect, something to talk about this partial goodwill. The original goodwill was calculated based on a 95% stake. Everybody agrees with that. Since 20% stake is sold, proportionate goodwill should be allocated to NCI. Proportionate goodwill should be allocated to NCI. This allocation of goodwill implies that original NCI of 5% did not have the goodwill because it was partial goodwill, but the new NCI of 20% will get the stake in the goodwill, This is only if you are having a partial goodwill approach that is being followed. Have you understood this? Yes. मैंने जब 95% acquire किया था, that time I followed partial goodwill. तो जो 5% NCI है, they don't have goodwill attributable to them. Now, out of my 95%, I am selling 20%. So when I sell 20%, what all will go into those 20% NCI? एक तो net assets on the date of sale का 20% will go, and the goodwill which is there, now that goodwill also will be going to those NCIs. That goodwill also will be going to the second set of NCI which is being created. So total NCI percentage, you are holding 75. That means your NCI percentage is how much? Your NCI percentage is 25. Out of this 25, the first 5% are not going to have any goodwill because it was on the basis of partial goodwill. The next 20% NCI, which is created not out of acquisition but out of stake sale, will have the goodwill allocated to them, will have the partial goodwill getting allocated to them. Is it okay? Yes. Have you understood? Clear? So this is the case of partial goodwill. If it is full goodwill, goodwill attributed to the parent in the COC account would proportionately be allotted to the new NCI. Goodwill attributable to the parent in the COC account would be allocated to the new NCI. That is all about stake sale without a loss of control. We then move to the next part, that is stake sale resulting in a loss of control. Okay. Now, when we talk about stake sale resulting in a loss of control, for example, I had 95%, I sell 70%, I am left with 25%. I was the controlling stakeholder, then I sold my stake, and now I only become the NCI. The parent becomes the NCI, NCI becomes the parent. So I am not concerned with NCI, I am concerned with myself, that is the parent. Okay. So now I lost my control. If I lost control over the subsidiary, can I control how the net assets will be utilized? Can I control how will I run the operations? Can I control how will I do the business of the subsidiary? Answer is no, you cannot. And if you cannot, acquisition ke time pe what all is coming in your consolidation, all those items have to be removed. So what is coming? Sir, when you acquired the control, you started recording the net assets. in your consolidated financials. You started recording goodwill or capital reserve, and you started recording NCI. So three things were recorded in consolidated financial statements. The first one is the net assets of the subsidiary. The second one is non-controlling interest. The third one is the excess or shortage that you have paid, which is your goodwill or capital reserve. When you lose this control over the subsidiary, all these three things have to be derecognized. All these three things have to be derecognized. Total derecognition. Total derecognition. So net assets were debited when you took over. You now credit the net assets. Goodwill was appearing as a balancing debit figure. Credit the goodwill. Capital reserve would be appearing as a credit balance. You debit the capital reserve. And NCI was typically a credit, so you debit the NCI. So you debit the NCI. Is it okay? Yes. Have you understood this? Have you understood this part? Yes. Have you understood up till now elimination of net assets, goodwill and NCI? अरे बोलो. अभी आप parent नहीं हो, and when you are not a parent, you cannot have net assets of subsidiary, you cannot have goodwill, you cannot have NCI. So you remove these items from the consolidated books. Sometimes you may prefer to hold a stake. You may prefer to hold a stake. So in the consolidated books, you will have investment in S Limited appearing. Now you remove the net assets, etc., etc. See, what students make a mistake is consolidated financial statements minus loss of control is equal to standalone financial statements. Most of you would be thinking like this, and this thinking, I don't blame you, because this thinking comes from the fact that you have standalone financial statements plus control to give you consolidated financial statements. Most of you think it in this way. Okay, sir, standalone था, control add किया, तो बन गया मेरा consolidated. And then you start thinking the reverse. Consolidated है, control निकल गया, it should fall back to standalone. Not needed, not necessary. Okay. I'll give you couple of examples. First one. You are an entity like Reliance Industries Limited, which has 50-60 subsidiaries. Reliance Industries Limited का consolidated financial statements minus, suppose it decides to sell Jio, minus Jio Telecom, पूरा stake बेच दिया. Do you think it will fall back to standalone? Answer is no. It will still fall back to Reliance Industries consolidated financial statements, 49 to 59 subsidiaries. Are you convinced about this part now? Consolidation minus control is going to remain a consolidated financial statement without that net assets. Is it okay? Yes. Is this first case understood? Yes or no? Arey, yes or no? Bolo yaar. Are you convinced about this? Okay. We come to the next part. Sir, हमारा तो एक ही subsidiary है. We are having only one subsidiary. Now you tell us how to do the consolidation. What will be the impact? So, suppose A Limited plus control. Why A? I'll make it simple. Na? P Limited plus control over S. is equal to CFS on date of acquisition. All right. So this is your consolidated financials on the date of acquisition. उसके बाद you have CFS on date of acquisition plus post profits. वो जो कुछ भी है you will go on recording. So you will be having CFS on subsequent periods, subsequent reporting dates, subsequent reporting dates. Okay. Now the question is, now please pay attention. CFS on subsequent reporting dates is going to be CFS on date of acquisition, CFS on date of acquisition plus profits, Yes, and these profits would be split into post acquisition profits, and on the corresponding side you will be having the net assets. Okay. So this is how the CFS in the subsequent periods will start to appear. You will have your post acquisition profit getting credited, and you will have the NCI on one side, and you will end up with the net assets coming entirely on the other side. So this goes on happening, and finally you are having CFS on date of consolidation, one of the days, minus loss of control. So when you end up losing the control, net assets will vanish. Your what you can say, your NCI will vanish, your goodwill will go away. All these three items which come from control, all these three items will go away. The net assets on the date of sale will go away. The NCI that was appearing will go away. The goodwill that you computed on the date of acquisition will vanish. And after that, what you will be left with is not going to be the CFS, is not going to be the standalone financials, because you still have some profits. These profits are made up of P Limited's profits plus profits of S Limited when P had control, over S. उन profits पे हक तो सिर्फ P का है. See, you earned profits when you had control over the subsidiary. That is why you started consolidating those profits in your profit and loss, in your consolidated P&L. Now when you sell the stake and lose the control, do you think you are going to sell the profits which you have earned? Answer is no, you cannot. वो profits आपका ही है, because that is going to represent your stake, that is going to represent your profits which you have earned when you exercise decisions over the operations of the subsidiary. It depends at what price you negotiate, etc., वो आएगा, it is going to come. But as of now, understand that in your reserves, consolidated P&L, abhi bhi post acquisition profits of the subsidiary will remain, because they were earned when you had control. So far, do you agree with me? Yes. So far, do you guys agree with me? Yes or no? So my basic point is, it is not going to be CFS. That is what I said. As of now, you agree with me? Yes. Then I'll come to the next aspect. I'm coming to that aspect, Soham. Just wait for some time. As of now, do you agree? Yes. As of now, you agree. Now we come to the next part. Sir, in case some stake is retained, create investment in the consolidated books. Create an investment. ठीक है. So I did not sell all the shares. I have kept some shares with me. Now it is no longer my subsidiary. तो मैंने उसको उठा करके निकाल दिया बाहर अपने बुक से. So now I will now be left with investments in the subsidiary. So that will be there. Now it all boils down to pricing. क्या हो रहा है? At what amount are you going to price your sale? At what amount are you going to price your sale? You will obviously be pricing your sale depending on what is the worth of the subsidiary that you are selling. And the worth of the subsidiary that you are selling will obviously include the profits that the subsidiary earned under you when you had the control over that. Okay, when you had the control over that. That depends on the pricing. So if you look at the final journal entry that will be passed, it will be looking something like this. Bank account debit. This is the price that you fix, number one. You will remove the net assets. So net assets credit. So assets will be credited, liabilities of the subsidiary will be debited. NCI will be removed. So NCI will be debit. Goodwill will be removed. So goodwill will be credit. So basically all my subsidiary के related जो कुछ भी है, मैंने सब हटा दिया है. If I have an investment, I will debit that investment. Ultimately, depending on how efficiently you are able to negotiate, it gives rise to a gain or loss. It gives rise to a gain or loss. Gain will be credit, loss will be debit, obviously. Okay. So this is depending at what price are you pricing it? At what price are you transferring it? Okay. So this gain or loss will ultimately go to the profit and loss account. Sir, why not other equity? This is not an owner to owner transaction now. Now you are coming out. That means it is viewed as you are selling net assets, because when you took the control, क्या किया था आपने? You took over the net assets. So when you're losing the control, you are selling. That means you are giving up the net assets. You are disposing of the net assets. So that is why it will be treated not as a disposal of stake, but it is treated as a disposal of net assets. It is treated as a disposal of net assets. देखो कहीं पर भी are you having credit to investment? होगा नहीं, because investment in subsidiary you yourself have eliminated, and therefore it will be taken to the profit and loss account. So it all boils down to this figure, and when you determine this figure, it will be added or subtracted from the post-acquisition profits in your consolidated financial statements. So ultimately, depending on this, it decides whether your CFS minus the control gives you the standalone financials or not. It could be standalone financials, but it will just be coincidence. It will never be the same. It will never be the same, because these profits and this profit, कहाँ गया? This profit can never be the same. Can never be the same. A lot of factors go when you are going to sell your stake. A lot of factors go into that calculation. So this and these post-acquisition profits will never be the same. So the likelihood of CFS minus control becoming standalone financial statements is very, very, very remote, and a high coincidence is needed to achieve that. Is it okay? Yes. Is it fine? All right. Moreover, the profit that you will calculate in the standalone financials on sale of investment will be entirely different from the profit that you calculate on the sale of investments on the sale of a controlling stake in the consolidated financial statements. We will see why that difference arises. We will see why that difference arises. But this profit and the profit that you are recording in the standalone will be different. Okay. It will not be the same. It will never be the same. Okay. It all depends on how you are going to negotiate this price. This is a market determinant factor. Whereas this is determined basis the books of accounts which you have prepared. So books of accounts are different. Life is different. So CFS minus control will never be equal to standalone financial statements. Don't ever have that thought process that CFS minus control is equal to SFS. It won't be. It cannot be. Practically also, it cannot happen. Is it okay? Yes, sure. But we can give a reconciliation of the profits that is there on the sale. Soham, are you okay? Yes. Are you okay? Yes. Sure. All right. तो ये हो गया मेरा stake sale. Now, what do you mean by a couple of things which we will be discussing? Okay. Something known as carrying value of the subsidiary on the date of sale. Carrying value of subsidiary on the date of sale. Net assets of subsidiary. So how we calculate net assets plus goodwill minus NCI gives you carrying value of subsidiary. This is what you are selling. This is what you are selling. Against this, you are getting the consideration. You can check this entry which is there. It is net assets plus goodwill minus NCI, which is the carrying amount of the subsidiary, which is the carrying value of the subsidiary. NCI would be what? It would be based on net assets excluding goodwill in case of partial. It would be including goodwill in the case of full goodwill method. Sir, in case 2, where there is only one subsidiary, future activities of S will never impact the consolidated profit and loss. आपका consolidated profit and loss वैसे का वैसा ही रहेगा for the years to come until you acquire a new subsidiary and make profits. वो कुछ भी कर ले, why will it start impacting my consolidated financials? I don't have control, तो उसका net asset भी नहीं आएगा, उसका goodwill भी नहीं आएगा हमारे पास. Is it okay? Yes. So future activities तो निकल ही चुका है वो हमारे यहाँ से. It has gone away from our net profits, from our net assets. तो वो है ही नहीं हमारे पास. So it won't continue. Okay. It won't impact us in any manner. All right. तो ये हो गया मेरा goodwill. Okay. Now the question is investments that will be retained. How do I record it? Do I record it at fair market value? Or do I record it at the proportionate carrying value? Proportionate carrying value means what is the carrying value of subsidiary divided by what was the stake before the sale multiplied by stake in proportionate. आपके पास 80% था stake, you sold 70%, you have retained 10%. So should you show the investment at 1/8 of the net assets transferred, or should you show at fair market value? That is the question. So you could follow any of these methods. You could follow any of these methods. Unless given, you will always follow proportionate carrying value method. Okay. Value of investments in standalone financials is not relevant for valuing investments in consolidated financial statements. Okay. It's not relevant unless it is a stake below 20%, in which case you follow Ind AS 109 principles. Okay. तो ये हो गया मेरा stake sale. This becomes my stake sale. All right. Fine. And now with this, let us come to some questions. Let us now come to some questions. Okay. All right. So come to question number 20. Come to question number 20. Stake sale. Stake is quite simple. It won't be much difficult. Okay. It won't be very difficult. It's manageable. Okay. Amla Limited purchased 100% subsidiary for 10 lakhs at the end of 20x1 when the fair value of the subsidiary Lal Limited's net assets was rupees 8 lakhs. Okay. So 10 lakh purchase, 8 lakh net assets. Goodwill kitna tha? Goodwill is 2 lakhs. Okay. This is your goodwill. 100% stake tha, so there is no NCI. The parent sold 40% of its investment in the subsidiary in March to outside investors for 9 lakhs. The parent still maintains a 60% controlling interest in the subsidiary. The carrying value of the subsidiary's net assets is 18 lakhs, including net assets 16 and goodwill of 2 lakhs. This is the same goodwill. Okay. Calculate the gain or loss on sale of interest in the subsidiary as on 31st March 20x4. Okay. So this is question 20. Okay. Bank account debit. You have sold it for 9 lakhs. Bank account debit 9 lakhs. Next. Your net assets is 18 lakhs. Your net assets is 18 lakhs. So 18 lakhs into 40%. So that gives you 7,20,000. That gives you 7,20,000. So that means what? You have been able to efficiently price your sale. So this gives rise to a gain. This gives rise to a gain, which will be recorded in other equity. To gain on creation of NCI, other equity. So this is 1,80,000. This is 1,80,000. Okay. All right. Standalone. This is extra. Question is done. Standalone mein what you would do? You had purchased these assets for how much? Purchased for rupees 10 lakhs. You are selling 40%. So the cost price is 4 lakhs. You have sold it for 9 lakhs. So standalone mein bank account debit 9 lakhs to investment in subsidiary 10 lakhs into 40%, 4 lakhs. So you will be left with profit on sale 5 lakhs. You will be left with a profit on sale 5 lakhs. Okay. Consolidation mein the profit was 1,80,000. Standalone mein the profit is 5 lakhs. Now, why is there a difference? Why is there a difference? Okay. Why is there a difference? See. When 100% stake was held, profit is equal to, see, it included net assets of 16 lakhs and when you had acquired, fair value was 8 lakhs. So 16 lakhs minus 8 lakhs. The profit that you had was 8 lakhs, which was consolidated in your P&L, which was consolidated in your profit and loss account. Now, when 40% is sold, 40% is sold, you end up losing this. So 8 lakhs into 40%, 3,20,000. 8 lakhs into 40%, 3,20,000. So therefore, 5 lakhs is your profit on sale in standalone, minus 3,20,000. You are attributing the profit to NCI, post acquisition profit. So you are left with consolidated profit of 1,80,000. You are left with consolidated profits of 1,80,000. Okay. This is getting transferred to the NCI. This is getting transferred to the NCI. Is it okay? Yes. Today, not many people are there. No. Done? All right. Understood. तो ये हो गया question number 20. Question number 20. Okay. Now we move on to the next question. Question 22. Let us see. Question 22. A parent purchased an 80% interest in the subsidiary for 1,60,000 when the fair value of the net assets was 1,75,000. Goodwill of 20,000 arose on consolidation under the partial goodwill method. Under the partial goodwill method. Okay. Saksham is also there. Good. Good to see you. Okay. All right. So purchase consideration is 1,60,000 plus NCI. NCI will be 1,75,000 into 20%. So that gives you how much? 1,75,000 into 0.2, 35,000. This is parent plus NCI minus net assets. 1,75,000. ये बना करके होता है मेरा goodwill. Goodwill is 20. So even if they hadn't given, I could have calculated this. An impairment of 8,000 was charged in the consolidated financial statements for the year ended March X3. So your goodwill minus the impairment, this is the value of goodwill. This is the value of goodwill. No other impairment charges have been recorded. The parent sold its investment in the subsidiary for 2 lakhs. The book value of the subsidiary's net assets in the consolidated financial statements was rupees 225,000 without including the goodwill of 12,000. When the subsidiary met the criteria to be classified as held for sale under Ind AS 105, no write-off was required because expected fair value less cost to sell of 100% of subsidiary was greater than the carrying value. Parent carried the investment at cost as permitted by Ind AS 27. Calculate gain or loss on disposal of subsidiary in separate as well as consolidated financial statements. So standalone or separate financial statements. भाई आपका क्या है? You have purchased it for 1,60,000. You are selling it for 2 lakhs. So in this case, your entry will be bank account debit, to investment in subsidiary, 1,60,000, to gain on sale, 40. This is plain entry in the standalone financials or separate financials. Yes, today is Sankranti. We are having it tomorrow also, Mitra. हमारे यहाँ कल है. Okay. Separate financial statements and then consolidated financial statements. Now what all are you going to do? सबसे पहले बैंक अकाउंट डेबिट 2 lakhs. Bank account debit 2 lakhs. Then you will have to eliminate the NCI. Have they given NCI value? The book value of the subsidiary's net assets in consolidated financial is 2,25,000. Is 2,25,000. Okay. So this is 2,25,000 into 20%. So this comes to 45. You will not include goodwill because this is partial goodwill method, NCI using proportionate share of net assets. That is why you will not be including this. That is why you will not be including this. So bank account debit 2 lakhs, NCI debit 45,000. You are losing everything that you have. So net assets will vanish, which is worth 2,25,000. Goodwill कितना था 12,000, वो भी चला जाएगा. To goodwill 12,000. The difference is going to be your profit on sale. The difference is going to be your profit on sale. 2,45,000. We'll continue for some time. Say by 11, I think I should wind up. Okay, latest by 11. Okay, 2,45,000 minus 2,25,000, 20 minus 12. So your profit on sale is 8,000. Your profit on sale is 8,000. Is it okay? Yes. Is it fine? You can either do it like this or you can think it of like this. Carrying amount of subsidiary can be calculated as net assets. Basically the same thing it is. Add goodwill less NCI. So this gives you 1,92,000. Selling price 2 lakhs. You have sold the entire stake. So 8,000 is your profit. 8,000 is your profit. Is it okay? Yes. अच्छा आपका भी कल है. Good, good. All right. So this takes care of the profit that you are making, which is 8,000. Which is 8,000. कहाँ गया? बंद कैसे हो गया? ओके तो ये हो गया मेरा रीजन फॉर, ये हो गया मेरा वर्किंग. इज इट ओके? यस. Soham, did you follow? All right. Fine. Now let us pull out another question. Question number 23. Question number 23. Okay. AT Limited purchased 100% subsidiary for rupees 50 lakhs on 31st March X1 when the fair value of the net assets of BT Limited was rupees 40 lakhs. Therefore, the goodwill is 10 lakhs. सब कुछ निकाल के दे दिया उन्होंने. AT Limited sold 60% of its investment in BT Limited on 31st March 20x3 for 67 lakh 50,000, leaving AT with 40% and significant influence. On the date of disposal, carrying value of net assets of BT Limited, excluding goodwill, is 80 lakhs. Assume fair value of the investment in associate is proportionate to the fair value of 60% sold, that is 45 lakhs. Calculate gain or loss on sale of proportion of BT in AT Limited separate as well as consolidated financial statements for the year ended March X3. Okay. So ये रहा 23. ये रहा 23. Standalone. Very simple. You have purchased 50 lakhs when the share was 40 lakhs and you are selling 60% of its investment. So 50 lakh cost price for 100%, 60% ka cost is 30 lakhs. You are selling it for how much? You are selling it for 67 lakh 50,000. So that gives rise to a gain. Bank account debit 67 lakh 50. Investment in subsidiary 30 lakhs to gain on sale. So this is 37 lakh 50. No significant influence, कोई बात नहीं, अभी तो हमने किया ना. Significant in आप निकल जाइए सोहम. You have your office, no problem. Saturday को भी काम करते हो. Okay, all right. So you can follow it later on. There is no issue. Okay, you can follow it later on. Please ensure that you watch the session afterwards. Okay, all right. To gain on sale 37 lakh 50. If there is no significant influence, no problem. Doesn't make any difference in terms of accounting at this stage. Okay, standalone financial statements. Significant influence and all that you will learn under Ind AS 28. I think which Kapileshwar sir will be taking for you. Okay, so I will not be having I'll not be able to take those topics for you. So Ind AS 28 and I think, yeah, that is accounting for investment in joint ventures and associates, sir will be taking. Okay. So consolidated financial statements, bank account debit 67 lakh 50,000. NCI debit, you were holding 100%. So NCI debit कुछ है ही नहीं because कुछ NCI था ही नहीं. Everything is sold off. Okay. You are retaining something. So investment account debit. Have they given the value to you? Yes, it is 45 lakhs. So investment account debit 45 lakhs. NCI, why it is 0? Since holding was 100%. Okay. Next one, to net assets. Chain holding I'll be taking now only. The moment I complete. This will be my last problem. Okay. Then I'll be pulling up chain holding and then we conclude. Okay. I'll just be touching up briefly on Ind AS 111 just to explain the concept. Otherwise, in terms of importance, it's not as important as consolidation. Okay. So this last problem and then the chain holding. Okay. To net assets. Kitna hai? So purchased this thing to net assets. The carrying value of net assets excluding goodwill is 80 lakhs. 80 lakhs to goodwill 10 lakhs. I have disposed of everything. Goodwill 10 lakhs tha. Yes. To gain on sale. Investment है तो remeasurement हो सकता है. We'll have to check. So this is 22 lakh 50,000 balancing figure. This is 22 lakh 50,000 balancing figure. Okay. So now let us do the other approach. Carrying value of subsidiary. How do I calculate net assets? Same thing it is. 80 lakhs. Goodwill 10 lakhs. Less NCI 0. So this is 90 lakhs. You have sold 60%, held or unsold 40%. So 90 lakhs divided by you had held 100% into 60%. So that gives you 54 lakhs. And this is 90 lakhs divided by 100% into 40%. 36 lakhs. 36 lakhs. Against this 54 lakhs, your sale proceeds are 67 lakh 50,000. Sale proceeds 67 lakh 50. So your gain on sale is 13 lakh 50,000. 36 lakh fair value of investment retained. They have given you to be 45 lakhs. So this gives you a gain on remeasurement of 9 lakhs. This is gain on remeasurement. Whereas this 13 lakh 50 is a gain on sale. This 13 lakh 50 is a gain on sale. They have already given the value to you. It is in proportion to the fair value of the 60% sold. That is, it is 45 lakhs. That is why we are having a mismatch. If they had to tell it will be proportionate value, then this would come at 36 lakhs. The proportionate value of investment retained is 36 lakhs. In the journal entry, this would be 36 lakhs, and ultimately the profit would fall to 13 lakh 50,000. So this would be the change if the investment is retained at the fair value or the proportionate value. So, sir, which method to follow? The question will specifically tell you, please follow that method. Okay, the question will specifically tell you, please follow that method. Okay, what I want you to do is, I want you to try a couple of questions. I want you to do question number 25. It's manageable. It's not difficult. Okay, and I want you to try question number 21. I want you to try question number 21. Okay. Simple hai, but just see if you can try it out. Okay. So do this and then you will be in a position to conclude your stake sale also. Okay. So that concludes stake sale. It's easy. It's not difficult. Okay. Anybody has any doubts in stake sale? Anybody has any doubts in stake sale? Or no doubts? Any doubts? No doubts? All clear? Okay, fine. Good. Shailendra, Saksham Lohia, Sumit Jain, Aniket. Today Aniket is not there. Okay, fine. All right. We now come to the last part of Ind AS 110, that is chain holding. So what happens is parent owns a control in the subsidiary. Subsidiary has another subsidiary. Okay, so ultimately parent controls S1, S1 controls S2. So indirectly parent controls S2. Indirectly parent controls S2. You don't have to check the stake of parent in S2. It's irrelevant because parent controls S1, S1 controls S2. So any decision regarding S2 will be taken by S1 and S1's any decision will be decided by P. So therefore, there will always be a control. Okay, there will always be a control. Control originates from power. Power is generally based on the voting rights. Power is generally based on the voting rights. Okay. So now if parent has a control over S1, a 70% stake, S1 has a 60% stake over S2, then P's effective stake in S2 is how much? P's effective stake is 70% into 60%. That is 42%. Though the effective stake is only 42%, that is less than 50, P exercises control over S1. S1 controls S2. So P can direct S1 for the entire stake of 60% in S2 in the manner P Limited wants. And therefore, P controls S2 even though it has only a 42% stake. So don't go by saying 42% we will not consolidated S2. आप ऐसे नहीं बोल सकते because you are ultimately having control over the share over the company by virtue of majority shareholding through your subsidiary. And as we said initially, even percentages don't decide. Even percentages don't decide. It's ultimately who controls the relevant activities. Okay. So NCI refers to share in net assets other than the parent. So NCI in this case in S1 is 20. NCI in S2 is you had 42%. So this will be 58%. This will be 58%. Okay. So when I analyze reserves and share capital of S2, okay, when I analyze reserves and share capital, 58%, this is 58% will be attributed to the NCI only for S2, only for S2, only for S2. Okay. All right. Fine. So ये कुछ theory है, ये कुछ theory है from when to consolidate. I leave this for homework. पढ़ लेना, it's just theory. I'll come to the actual consolidation process. I'll come to the actual consolidation process. It should be 30% in S1. Which one are you talking about? This should be 30. That's right. That's right. This should be 30%. 100 minus 70. 30%. NCI in S2 58%. Okay. 1 second. ये थोड़ा गड़बड़ है. 100 minus 70%, 30%, and then this is 40% into 30%. Something is not right. NCI in S1 is 30%. That is correct. NCI in S2 is 42%. Did I calculate this correctly? 70 into 60%, 42%. Okay, so 58%. Yes. Piece effective stake. It is going to vote entirely. Okay. Determination of NCI 30%. And NCI in S2 is 58%. Yes. This represents share in net assets of S2 100 minus 70 होना चाहिए, and this should be okay. 1 second. Okay. NCI calculation. I'm just redoing it here. We'll get 58%. Okay. So NCI in S1 is equal to 30%. NCI in S2. This will be split direct and indirect. Okay. Direct NCI in S2 is where am I? One second. Okay. Direct NCI in S2 is 30%. Just a minute. Others all are correct. Okay. 40% was for S2. Yes. All right. So 30 into 40%. Yes. Others are all correct. All right. That's fine. So we stick to this. Okay. Others all are correct. Only that change was there. That is done now. Okay. All right. Fine. So ye theek hai. Simply got confused. Okay. All right. Fine. Okay. So this takes care of that part. This is direct stake 40% and indirect stake is 18%. So that gives 58. This is also fine. All right. Great. So while analyzing, so what will be the impact on the consolidation process? What will be the impact on the consolidation process? Let us now try to understand. Okay. See, the steps remain largely the same except for the following changes. First step is you prepare the balance sheet in Schedule 3 format. Note 1, Note 2 you prepare. Calculate NCI percentage of parent in S2 and then NCI percentage of parent in S2. Then you determine the date of acquisition of parent in S2. That is the date when the control is acquired. Then you come to elimination of investment by S1 in S2. Now it starts to move this way. Okay, understand this part. This is the only change which is happening. Okay, see, in my COC account, I would eliminate investment of parent in S1. Obviously, sir, you have to eliminate investment of parent in S1. But you will also have to eliminate the investment made by S1 in S2. Made by S1 in S2. So you will have to eliminate investment of S1 in S2. Now please pay attention. We are ultimately preparing CFS of the parent. We are ultimately preparing CFS of the parent. The investment made by S1 in S2 is a part of S1 Limited's balance sheet. And S1 Limited's balance sheet, all assets are attributable as 70% to the parent and 30% to the NCI. Hence, elimination of investment cannot be done fully through the COC account, because see, when parents share in S1 I eliminate, that belongs solely to the parent. Okay. See, when I do my COC account, when I do my cost of control account and I eliminate to investment in S1, this investment in S1 of the parent is solely belonging to the parent, किसी third party का नहीं है. But if I have to eliminate investment in S2, who has invested in this? S1 has invested in S2. अरे S1 के तो इन्वेस्टमेंट जो है, it is itself going to be divided between parent and NCI, and therefore I cannot eliminate entirely here, because I am preparing whose consolidated financials? I am preparing P Limited's consolidated financials, and that is why I cannot eliminate entirely S investment in S2 here, because S1's assets are ultimately being shared as 70% to the parent and 30% to the NCI. Okay. So instead, P's share in the investment will be eliminated through the COC, and NCI of S1 will have a share of 30% in the investment, which will be eliminated by ultimately deducting it from NCI of S1. NCI would be computed in the usual manner, but at the end, NCI's share in investment of S1 in S2 will be deducted, showing the net amount in the consolidated balance sheet. So you would be having something like this: COC account debit, parents share in S1, full amount, to investment in S2, NCI account, NCI's share in S1. Okay, this is how it will happen. Okay, split S2's reserves and share capital in the ratio of effective stake. So what we will do is, first let us try to solve this question, one of the questions which is there. And once we try to solve that question, a lot of your clarifications on this process will get addressed by itself. Okay. So let us look at the question. It's, I think, question number 14. Okay. Mark this as extremely important because it has come a couple of times in your examination. Okay. Prepare the consolidated balance sheet of March X2 of a group of companies comprising P Limited, S Limited, and SS Limited. The balance sheets are as given below. You are given property, plant, and equipment. Investment, P has invested in S and S has invested in SS. So ultimately it is like P in S in SS. And now we are preparing this entity's consolidated financials. So now we will have to decide how to do the consolidation. Okay. All right. Inventories, trade receivables, bills receivable, cash bank, share capital, reserves, retained earnings, trade payables, bills payable. The following additional information is available. P Limited holds 80% shares in S. S holds 75% shares in SS. Their holdings were acquired on 30th September 20X1. Activities are not seasonal, therefore profits are earned evenly throughout the year. On 1st April X1, the following balances stood in the books. Reserves, opening balances, retained earnings are given. 10 lakhs included in the inventory of S is the inventory which has been purchased from SS. Parent has adopted an accounting policy to measure NCI at fair value. Assume market prices of S and SS to be the same as the respective fair value. So you will have to look at this question now. How do I solve it? Okay. So now balance sheet is done. Record the items of assets and liabilities as it is. Don't make any adjustment. Okay. I'll be a little fast for the regular steps. Okay. So that we can focus more on the important parts. So 320, 220, trade receivables 260, bills receivable. So this comes to 332. Cash and cash equivalents 228. Trade payables 470, bills payable 30. This is 500. Okay, I'm just copying. I'm not doing anything as of now. 360, 70, 100, 40, 230, 70, 300. SS 300, 50, 220, 30, 250, 40, 180, 180. Okay, so this is your assets. Equity share capital of the ultimate parent only will come. So that is you are having it here 600 lakhs. So 60 lakh shares. Okay, so 60 lakh equity shares of rupees 10 each, fully paid 600. Okay, so we copy 600 as note number 2, 600.00. It's rupees in lakhs, so you can keep the decimals. Okay, all right, so this takes care of equity. Next we come to note number 3, other equity. In other equity you are having reserves and retained earnings. Working note 2 से आएगा ये. Okay, this will come from working note 2. And now we come to the important ones, that is the stake calculations. Parent acquired stake in S. On which date? It acquired the stake on 30th September 20x1. How much did it acquire? 80%. S acquired shares in SS. How much did it acquire and when? When is the same, 30th September 20x1. S has acquired 75% stake. S has acquired 75% stake in SS. Okay. So when I talk about SS, and okay, now let us look at the stakes. If I talk about S Limited, P Limited stake is 80%, therefore NCI stake will be 20%. If I talk about SS Limited, P Limited direct has no investment in SS. Indirectly, does it have? Yes, 80% into 75%. So indirectly it has a 60% stake. Therefore, NCI is equal to 100 minus 60, 40%. NCI is equal to 100 minus 60, 40%. Are you okay so far with the stake calculations? Are you okay with the stake calculations? See, this part is very important because this will be the basis for calculating my reserves. This will be the basis for doing allocation of the reserves. So far, is everyone clear with the stake calculations? Yes? All right. Now this stakes, we will place it in our cost of control. Okay. Immediately, please place this. 80% is my percentage and I am holding 60%. Put this in a box. 80%, 60%. So your NCI will be 20%, 40%, 20%, 40%. Okay. All right. Consolidated other equity. Let us first record the standalone balances. Retained earnings. 180 and 160. 160.00. Okay. Everything is done. Everything is accounted. All the things are done. And now we proceed with recording the items. Everybody is there with me, or anybody is still confused or copying or writing? I want all of us now to come on the same page. Okay, fine. So now we start the elimination of, see, ये हो गया है inventories, trade receivables, bills, bank. This I have copied. This is done. This is done. This is done. So now, and this is also done. Okay. So now we are eliminating this investment. Now, who is investing shares in S? Sir, P Limited has invested shares in S. P Limited is the sole owner in S Limited. So for S Limited, there is no problem. We can directly eliminate 340. So come to your cost of control to investment. It is exclusively the property of P. So parent in S. This is 340. This is 340. So I have eliminated this. I have eliminated 340. Now the question is, what about this? What about 280? What about 280? Sir, I will eliminate 280 also entirely. No, उसमें गड़बड़ क्या है? उसमें गड़बड़ है. Whose consolidated financials are you preparing? Are you preparing S Limited's consolidation? If you are preparing S Limited's, go ahead and eliminate 280. But you are not preparing S Limited's financials. You are preparing P Limited's financials. P Limited does not have a direct holding in SS. P Limited is having an indirect holding in SS through S. And S, every asset, every liability of S has to be split between the parent and the NCI. Has to be split between the parent and the NCI. So when I am preparing P Limited's consolidation, can I eliminate the investment in S entirely? Answer is no. Answer is no. You cannot eliminate it entirely because each and every asset of S, 80% belongs to P, 20% belongs to NCI. So I can eliminate only to the extent of 80%. Have you understood? Yes. Have you understood? Yes. So P in SS, how much can you eliminate? Sir, we will eliminate 280 into 80%. That gives you how much? गलत कॉलम में लिख रहे थे 224. Have you understood this? Everybody has understood this. Don't look at this ratio and say that this ratio and this ratio are different. Don't eliminate as 280 into 60%. Don't eliminate as 280 into 60% because 60% is the ultimate reserves which will flow to the parent from the SS Limited company. So don't ever say that. See, S Limited. Okay. S Limited, who is holding? P is holding and NCI is holding. Correct? So 80% is held by P and 20% is held by NCI. So therefore, when I eliminate P in S, P के ऊपर कोई और बैठा नहीं है. So the entire 80% P in S is going to get eliminated because it is a normal investment. It is a normal investment. But when I go further down the line to SS, SS के केस में, in the case of SS, S is holding how much? 75% and NCI is holding 25%. So now if I have to eliminate this investment, if I have to eliminate this investment, a part of this investment belongs to this NCI and a part of this investment belongs to parent. That is why I cannot do a full elimination of investment in SS through the COC account because they are having a portion attributable to NCI. In this case, parent के सर पे कोई और नहीं है. There is nobody else. It's just the ultimate holding company. And therefore, we do a complete elimination. Okay. See, parent is the sole owner. Parent के ऊपर there are owners of the entity. That's it. Parent के केस में this is the ultimate holding company. So parent will never have to do a split elimination. The assets of P are solely attributable to the owners. P का कोई NCI नहीं है. The parent does not have any NCI. The parent is solely under control of its owners. Be careful. Don't get confused with this NCI. This NCI does not hold any shares in P Limited. This NCI does not hold any shares in P Limited. P के owner तो कोई और है. P somebody else is owning. Okay. So these owners are having absolute control to the extent of 80% in S Limited. And that is why we are eliminating it entirely. So remaining 20%, जा रहा है ना NCI में. We will do that elimination in the NCI. But here, this investment is solely under the control of the parent and the owners of the parent. Have you understood why P is eliminated entirely? That is what we have been doing, no yaar, so far. So far, every time we used to do the consolidation of P in S, तो हम लोग पूरा तो eliminate करते थे ना. We used to eliminate P in S entirely. The problem arises when I am eliminating S in SS. When I'm eliminating S limited in SS. Problem क्या है यहाँ पे? सीधा सीधा elimination नहीं कर सकते. Because every asset of S limited belongs partially to P and partially to NCI. So therefore मैं total elimination करूंगा यहाँ पे, नहीं ठीक होगा, because my cost of control is not the entire stake. To invest the 75% in SS, to invest the 75% in SS, दो लोग contribute कर रहे हैं. One parent is contributing to the extent of 80%, NCI is contributing to the extent of 20%. दोनों के fund मिला के मैंने SS में invest किया है. So the investment in SS is ultimately going to be shared by two people. One is by P and the other is by NCI. And therefore, the elimination of 80% only can be done through the cost of control account. Harshad, did you understand? Yes. Yes. Harshad, did you follow? Kaushiki confirmed. Srishti has confirmed. Yes. Harshad, did you follow? I'm waiting for Harshad's response. Harshad? Okay, Shailendra has confirmed. Harshad is not yet. Okay, anyways, those of you 5 are watching live streaming. 3 have confirmed. बाकी 2 हम खुद ही देख रहे हैं. मैं भी अपना सेशन देखता रहता हूँ. Okay, all right, fine. So I hope Harshad has understood. Okay, तो ये हो गया. Sir, now the question is, sir, we have eliminated only 80%. Remaining 20% हम कहाँ eliminate करेंगे? See, out of this 280, we have eliminated 224. बचा कितना सर? बचा 56. ये elimination कहाँ होगा? इसको हम लोग pending रखते हैं. We'll keep it pending. I will be discussing it at the appropriate time. So that is why I am not coloring my 280, because 280 is not yet eliminated completely. We'll come to that 56 later. बाकी का कहानी खत्म करते हैं. Yes, we'll complete the remaining. Okay. Now we start eliminating the share capital, reserves, etc. So here I will have by equity share capital. Okay. Now equity share capital S limited. How am I going to eliminate? Don't get confused. P and S ka rishta is straightforward. Don't get confused. P and S is straightforward. 400 into 80% straight away. 400 into 80%. Straight away, there won't be any problem here. It is same thing. And the remaining will go to NCI. So by equity share capital S limited, 400 into 20%, straightforward elimination 80. And here straightforward elimination 320. So this comes to entire elimination of 400. Same to same, there is absolutely no problem. Now we come to SS Limited's equity capital elimination. SS Limited. Now see, when we talk about SS Limited, I am preparing whose consolidation? Ask that question. I am preparing whose consolidation? Sir, we are preparing P Limited's consolidation. So when we are preparing P Limited's consolidation, remember, investment is eliminated, reserves, equity capital is eliminated between the parent and NCI in the ratio of their holding. That's what we have always been doing. That is what we will again be doing. So therefore, my SS Limited ka share dekho, it is held to the extent of 60% by P and NCI is 40%. It is held indirectly to the extent by P 60% and 40% NCI. So all the reserves, all the capital of SS Limited will be divided between the parent and the NCI in the ratio of 60% and 40%, and that impact will be given in the cost of control account as well as the NCI account. So this is also comparatively straightforward. So this is going to be 320 into 60%. So 320 into 60% gives you 192. And here this will be 320 into 40%. This is 128. Have you understood this? Have you understood this? Yes. It's a straightforward elimination. Okay. All right, fine. So now we come to analysis of the reserves. Okay. चलो reserves की बात करते हैं. We start with S Limited and then we analyze SS Limited. Okay. We start with S Limited and then we move with SS Limited. Okay. So reserves कितना है? It is 100. It is 100. On the date of acquisition, it was 80. On the date of acquisition, it was 80. Okay. So the increase in reserves is 20. So the increase in reserves is 20. $100 minus 80 is 20. So 100, let me split it between pre and post. This is first October X1 to 31st March X2. Obviously, I got the profit at this point of time. Okay. So balance is given to you as 80. Add 6-month profit, 20 into 6 by 12, 10. So this gives 90. So this is 6-month profit only. यहाँ पे कितना आएगा? 10. So 10 in, how is that 10? Same, 20 into 6 by 12. So 10. And we split this. Which ratio? 80-20. 80-20. This goes to P, this goes to NCI. So this will be 72, 18, 8 and 2. And this will go in working note 3, that is COC account, working note 4, NCI, working note 2 and working note 4. All right, fine. So give the effects, give the effects, go to your COC account by pre-reserves, working note 5. This is 72. This is 18. By pre-reserves, 18. Don't write post because there is a fair valuation. So, I mean, if you are writing post, write it towards the bottom. Okay, write it towards the bottom so that by post reserves. This is 2. Post reserves 2. This is 72. And then go to your consolidated earnings working note. Add share in post reserves S Limited. कितना है? 8. ओके, तो ये हो गया मेरा एक चीज एलिमिनेटेड, एनालाइज्ड, सॉरी, 100. Okay, now we do the same thing with retained earnings. Yes, retained earnings 50. On the date of acquisition, it was 20. I mean, on 1st April, so 30. So 15, 15. We will have to analyze and finish it off. Okay, so it's fairly the same. So increase in X1, X2. 50 minus 20 equals 30. So 50 pre up to 30th September X1, post 1st October to 31st March X2. Balance on 1420 X1 is 20. Add 6-month profit. 30 into 6 by 12, 15, 35. Here it will be only 6-month profit. So this is 30 into 6 by 12. So split it between parent and NCI. Parent and NCI. 80, 20, 80, 20. So this is 7. This is 28. This is 3. This is 12. Working note 3, working note 4, working note 2, and this is working note 4. Okay, straightforward elimination once again. So we take it accordingly. This is working note 2. So let us post it by pre-retained earnings. Working note 5. Retained earnings is 28 for the parent. Retained earnings. Working note 5. This is 7. Then add share in post retained earnings S Limited. This is 12. This is 12. And then by post retained earnings. This is 3. This is 3. Is it okay so far? Is it okay so far? Everybody has understood? Those of you who are there, all clear? So I have eliminated this as well. I have eliminated this as well. Okay. Any doubts? Okay, fine. Let us now move on. Let us now move on to the next part. That is, there is somewhere a intercompany sale that is happening. The 10 lakhs included in the inventory of S is inventory which has been purchased from SS. Okay, so we will see that when we are analyzing SS. Okay, so let us start with analysis of reserves of SS. So SS, we will take the movement in reserves to retained earnings. Reserves will keep it simple. So increase in 20x1, x2. Let's come back. Reserves was 80 and on April it was 60. So 20. So 80 minus 60 equals 20. So now we do the split for 80. Pre, post, up to 30th September X1. This is 1st April X1 to 31st March, 1st October, not April. X1 to 31st March, X2. So balance on 1st April X1 is 60. Add 6-month profit 10. I'll not write the working because it's taking time. Okay. I hope it's clear. 10, 10. So split it between parent and NCI, parent and NCI. This split will happen in 80-20 or 60-40. This split, yes, chain holding and step down subsidiaries are the same, absolutely same. Okay. So P and NCI. So this will be 60 and 40, not 80-20. 60 and 40. So 42, 28, 6 and 4. Where will it go? Working note 3, working note 4, working note 2, working note 4. Okay. So these items are going to be recorded here. And now we proceed to record the items respective places. Add share in post reserves SS Limited. Post reserves कितना है 6. This is all working note 5, 5, 5. Okay. 6 हो गया. Go to cost of control credit side. By pre-reserves, this is 42. By pre-reserves, this is 42. NCI का pre-reserves, this is 28. This is 28. Okay. Then we move on to retained earnings. Retained earnings. Okay. So increase in 20x1 x2. Bear with me for just another 5-10 minutes. Okay, this is done. This is done. Now we look at retained earnings. 60 minus 30, that is increased by 30. So we proceed to analyze this 60. Pre up to 30th September x1. Post 1st October to 31st March x2. So balance on 1st April x1 कितना था? This was 30. Add 6 month, increase 15. So this is 45. Balance on 1st October x1. Now we proceed to post. Post के केस में 6 month profit 15. Can I proceed to split this? No, because you have some unrealized profit. So we will do the unrealized profit on upstream transaction. Let us look at the adjustment. 10 lakhs is the inventory which is included in S, which has been purchased at cost plus 25%. So cost plus 25 means what? If cost is 100, 25 will be your what you can say, 25 will be your profit and 125 will be your selling price. So cost plus 25 means 1/4 on cost. 1/4 on cost means 1/5 on selling price. So 10 lakh worth inventory means 2 lakhs will be the profit which is included in that. Okay, so you can directly do it, or I'll just keep a simple working. Cost plus profit gives you selling price. Cost is 100, this is 25, this is 125. Inventory, this is 10, so this will be 2 and this will be 8. Okay, cross multiply. This is a question mark. Okay, so cross multiply. This 2 becomes your unrealized profit. So let us go ahead and give the unrealized profit effects. Post P&L of SS, debit to inventory, 2. So this will go in working note 6. This will go in note 1. Note 1. So let us go to working note this thing. Less unrealized profit 2. So this gives 13. Now we do the split. P NCI, P NCI, 60, 40, 60, 40. So 45 into 60% gives you 27, and this is 18. 13 into 60%, 7.8, and this is 5.2. Working note 3, 4, 2, 4. Okay, so let us post these items in the respective transactions, in the respective notes. So add share in post retained earnings SS. SS जहां भी लिखा है, it is working note 6. Okay, so this will be 7.8. Then here pre-retained earnings kitna tha? This was 27. Working note 5 and 6. Pre-retained earnings for NCI is 18. Again, it's working note 5 and 6. Post-retained earnings for NCI, post SS, मैंने कुछ भी post नहीं किया क्या इसको, NCI को? Okay, this I did not post. All right, fine. We'll post this. This is 4 and this is 5.2. This is 5.2. Fair enough. Now, ये हो गया मेरा adjustment. Inventory में कम करना पड़ेगा ना. We have to reduce it from the inventory also. So note number 1, assets and liabilities. Inventories में से हम कम कर देंगे. We'll reduce it from inventory. There are some intercompany bills receivable and bills payable which we will have to eliminate. You can see here in S Limited's balance sheet, bills payable P Limited is 70. So we will eliminate 70 from bills payable as well as bills receivable. So bills receivable minus 70 and bills payable minus 70. एक हो गया. This is eliminated, and here also there is 30 and 30. Okay, 30 and 30. Okay, 30 and 30. Okay. All right, ये 72 में से 70 इसका है, तो 2 बाहर का भी हो सकता है. It's not necessary कि पूरा इंटर कंपनी ही होना चाहिए. Okay, so that takes care of the eliminations. That takes care of the eliminations here. Then we proceed to the fair valuation, to the fair valuation of NCI on the date of acquisition. दिया है ना उन्होंने कहीं पे fair valuation बोल के. The parent company has adopted the policy to measure NCI at fair value, applying Ind AS 103. Assume that they are the same as face values. Okay. It is given that fair value of NCI are same as face values. Therefore, total fair value of S Limited, SS Limited is how much? This is S Limited is 400. This is 320. NCI's share here is 20%. Here it is 40%. So here it comes to 80 and here it will come to 128. Okay. This is all in lakhs. All of it is in lakhs. So 80 and 128. Okay. So carry it forward. Go to NCI to balance, carry it down. To balance, carry it down. 80 and 128. Total karo 80, 98, 705, 128, 3s are 24, 2 to 4 to 6, 7, 174, 105, 174. We are left with a capital reserve 25 and 174 minus 128, 46. To capital reserve. To capital reserve. Okay. ये रहा हमारा working. Just a second. Okay, so यहाँ पे आएगा by balance brought down. यहाँ पे आएगा by balance brought down 80 and 128. Total this up, you will be left with 85 and 137.2. 85, 137.2. To balance, carried down. Yes, we are done. Now we balance the cost of control. Let us check what we get here. 320, 77 to 900. ये 420 हो गया. This is 192, 7292, 11, 191, 10, 6, 2, 420, 261. So this also gives rise to a capital reserve 80 and 37. To capital reserve. Okay. Now capital reserve in the balance sheet. Capital reserve in the balance sheet. That is NCI valued based on fair value. Okay. That is NCI valued based on fair value. So S Limited, COC, working note 3, this is 80. NCI, working note 4, this was 25. So total capital reserve on S Limited is 105. SS Limited from your COC account is 37. From the NCI, working note 4 is 46. Yes. So 37 plus 46 gives you 83. So 105 plus 83 gives you 188. This is your full capital reserve. Why full? It's attributable to parent as well as the NCI. तो ये हो गया मेरा full capital reserve 188. And now we come to the NCI. Now we come to the NCI. Okay. S is 85. SS Limited is 137.2. So the total here is 222.2. And now you come to the question. We have eliminated this. Is everything eliminated? No. This part is now going to get eliminated because this is the NCI's share in the investment of SS. So it is an asset share. It is their share in the assets. So we are going to eliminate it against their liability. So less investment by NCI of S in SS. This is 280 into 20%. 56 is eliminated here, and now this gives you net NCI of 166.2. We are eliminating the NCI. It is their share in the asset. This is their dues. Their share in the asset is 56. We are eliminating their share against their dues to arrive at 166.20. To arrive at 166.20. And now let us proceed to total the reserves. This comes to 194. This comes to 179.8. Okay. So reserves would stand as 194. Retained earnings 179.8 and capital reserve. This is working note 3. 188. Total this up. You should be left with 561.8. Total up the assets and liabilities, no other adjustments. 320, 360, 300, 333. So this is 980. 220, 120. So that gives me 340 minus 2, 338. 260, 480, 580. This gives you 2, 330. So total is 582. 228 plus 80, 308. 470 plus 186, 50. 850, 880. This will go away entirely. So we are left only with 880. And now post everything in your consolidated balance sheet. It should tally. 980. Goodwill, nothing is there. Inventories 338. Trade receivables 580. Cash and cash 582. Sorry, including the bills. Cash and cash equivalents is 308. 308. So this comes to 2208. Equity share capital we have written. Other equity, working note number 3, 561.8. All of this is note number 1111. Financial liabilities, you have NCI very important. Your NCI figure is 166.2. Working note 4. Trade payables is 880. If you add this up, let's hope it comes to that 561.8, 16880, 2208, and that concludes your question. That concludes your question. Have you understood? Yes? Any doubts? Any doubts? No doubts? Yes. So very, very important to understand. The basic point is the elimination. Now, if you read the theory on elimination, you can see the investment made by S1 in S2 is a part of S1's balance sheet. So we saw that. All assets appearing in S1's balance sheet are attributable to parent and NCI. Hence, elimination of investment cannot be done fully. Cannot be done fully. Okay. Now, instead, P share will be eliminated through COC, and NCI of S1 will have a share which will be eliminated by ultimately deducting it from the NCI of S1. So we have done that. We have done that. NCI would be computed in the usual manner based on effective stake of P in S2. But at the end, the NCI's share in investment will be deducted, showing the net amount in the consolidated balance sheet. So that is how we do the elimination. That is how we do the elimination. Okay. So that concludes our discussion on Ind AS 110. A couple of topics are not so important. I would advise you to go through them. First one is optional preparation of consolidated financial statements. Are optional in certain cases, like where your intermediate holding company is not required to prepare financial statements, CFS, when the ultimate holding company is required to prepare consolidated financials. So that part is left. You can go through that. It's plain theory. Go through the study mat for all the topics. I have covered as far as I could in great detail over the last 6 sessions. So go through this point. It's a small theory topic which is there, should not take much of your time. The second one is joint arrangements follows proportionate consolidation. What do you mean by proportionate? जितना आपका share है उतना ही आप consolidate करोगे. What method we have done in Ind AS 110 is full consolidation. All net assets are taken over. In proportionate consolidation, only part of the assets are taken over. So we saw that joint control can be of 2 types. One is in the form of joint arrangements. Okay, joint arrangements meaning where a separate entity is not incorporated. Okay, and you could have a joint venture where a separate and this thing is incorporated, where a separate entity is incorporated. Where separate entity is incorporated, that is under Ind AS 28, which you will be doing it in detail in the forthcoming classes. Joint arrangements may we don't have as such practical questions of a great deal. You can go through the institute study mat. There are a couple of questions. I think you will be in a position to understand. Basically, हमने जहां पे net assets complete लिया है, वहां पे proportionate लिया जाता है. You will have goodwill as a similar concept. You will have capital reserve as a similar concept. Purchase consideration as a similar concept. So everything is quite similar. Only thing is it will be on a proportionate basis. So please go through that. Okay. And if you have any doubts, let me know. I will address them. Okay. So that takes care of this bonus. Okay, so now if we start to analyze your consolidation, balance sheet note number 1, working note 1 is ये सब चीजें इतने ज्यादा marks देंगे नहीं आपको. In the consolidation, the most important one starts from cost of control account analysis of reserves. If you get a consolidation question of 16 marks and you find that you are short on time, at least ensure that cost of control, NCI, analysis of reserves, these three are done accurately. Out of 16, you should end up scoring at least 11 or 12 for these. Okay. Exact allocations I am not aware of, but at least in my understanding, at least 70 to 75% of the questions marks will be attributed to these four notes. Okay. तो टाइम का अभाव है, टाइम कम है आपके पास, do these four notes, give the goodwill figure, the capital reserve, the NCI and the reserve split. You do this, then it's just a matter of posting and the adjustments. Your adjustments, we covered dividend, we covered fair value, we covered goodwill impairment. All these adjustments, you give the impact, and then be rest assured it's just a matter of punching the figures into the consolidated balance sheet. You can leave that if there is a time paucity. Okay, so that takes care of 110. It was great. I still have one topic left to take you through, that is common control combinations. I'll see if I can do it on 28th and 29th. By extending the sessions, I will try to do it on 28th and 29th. So stay safe, study well, and see you guys on the 28th with Ind AS 19 that deals with employee benefits. Okay, so we pull up employee benefits at that point of time. Until then, study well and all the best. Okay, so take care everyone. Thank you. Vinu?